Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Another day up on Wall Street. The big question is, after yesterday's big rally, 300-point rally on the Nifty, is there more and is there an all-time high? Once again, very, very close by. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, good morning.
Hi, morning Nigel, morning Prashant, and yes, indeed, we were counting down, right? We came some 70 points away from that sort of mark, but actually it was a very great trading session yesterday. It was so well-rounded, and we've got fairly decent cues this morning as well, so is today the day?
Well, today's the day, from all through November I've been saying that, and then I was getting a little nervous because we're running out of days in November, but we have got 2 to go in this month in terms of trading days. And today's the day. It's a fresh all-time high. Prashant's dressed appropriately, as I can see.
Happy in pink.
Yeah.
I'm neutral in white.
I think Flash chala dete hain. All-time high.
Market's all set to hit fresh all-time highs.
No, hits all-time high. Okay, anyway, let's just take it from the top, right? In terms of what you need to know as we begin a new trading session. US continues its repair and recovery. Nifty once again eyes new all-time highs. I mean, we got to about 25 points. We got closer earlier than we got yesterday. The high is 26,277. It was hit late September. 27th of September is when we hit that. And then, of course, we know what happened, right? There was the US presidential election. The results came in sometime in November. The swearing in was in January. There were tariffs. There was a big sell-off into Liberation Day, which is in April. The market made a low. And then from the Liberation Day lows in April, the market's basically been coming up. And we are now about 60, 70 points away. Now, US, right, and equities rallied once again. And there is, of course, rising expectation of interest rate cuts. And it was 40-60, 50-50. Now I think there's more who are expecting a cut than those who are not. S&P 0.7% higher. The NASDAQ about 0.8%. VIX was down 7.5% last night. So this is actually pretty good overall. And this also, of course, putting to rest some nerves around the AI trade in the US. Dell, for example, I mean, just to talk about AI, was up. It reported numbers the prior day after close, but 6% last night. It said it's received a record number of orders for its AI servers. So that's one more name rallying on the back of this AI thing, right? Oil prices 1% higher, 63, but Brent oil prices are down 4% in the last 1 week. And the big global geopolitical story, of course, is likely to be, I mean, if we actually come to it, there's always room for a slip between the cup and the lip. But the point is, markets are reassessing the prospect of a potential Russia-Ukraine peace deal. And we'll see if that actually does happen. It looks like we are very close. But we've been close before, maybe not this close, but we'll see. And, we're going into the weekend over the next couple of days. I mean, one more day to go. Will we hear something as we come back? Jobless claims data fell 6,000 to 216,000. Consensus was 225. It's the lowest since the mid of April. I don't think this is a number that you'd quarrel with. U.S. cash markets are closed for Thanksgiving tonight. I think futures will trade up to a certain point, but the big cash market is closed. So that is not there. GIFT Nifty will come up on your screen, gives you a quick sense. I'm not putting out, I mean, the 20-day remains a support. And with yesterday's move, you've put enough distance. So I don't think you need to worry about that today on both the Nifty and the Nifty Bank, which has been the trailing stop loss, as we've been indicating. We came very close and you hit almost hit the 20-day day before yesterday. And then yesterday we had this big bounce. So maybe we should look up rather than down, at least for today's session with the overnight handover as well. 50 points higher on the GIFT Nifty. And of course, the question is a new all-time high today, 70 points away. Nigel is standing by with what the F&O stats looking like. And it's going to be interesting to understand what happened yesterday. There was that big Bharti block deal influencing the FI cash figure. But what else in terms of the F&O side? Nigel, take it away.
Well, that's right. The cash market trends are going to be important from here on. But as you said, yesterday's number was skewed because of that large trade. Though it's good to see at least the FIs, they're not selling, anywhere close to as aggressively as we saw a couple of months or so. But today's the day. And after 14 months, the Nifty is all set to revisit the fresh all-time highs. That's the number you're looking at on the screen. And we're 70 points away. I think in the first few minutes itself, we go to those fresh all-time highs. So today's the day, always a good feeling, right? And the global backdrop is very, very good because the US markets will be shut today. Tomorrow, they're open only for half a trading session. So no scare could come overnight, so to say. And the Troika as well behaved. Dollar index has cooled off from around 100.5. Just the past week, it sat around 99.5. Brent crude prices at very, very subdued levels. And now the street is bracing for that rate cut. 85% probability going by the Fed funds tracker out there. So that rate cut from the Fed, that's expected. What did the FIs do on index futures? Well, yesterday's trading session, they covered very, very mild shorts on index futures. They added some longs as well, though we continue to remain net short at close to around 83% of the positioning on the short side. In absolute terms, the FIs are net short with close to around 90,000 contracts on the short side, while the clients are net long. So both of them, the FIs are not as short as what they were, say, a few trading sessions ago, and the clients not as net long as what they were. But this combination is normally good, with the FIs being net short in the system. Gives you a reason to expect a bit of a short covering bounce. What about the PCR? Well, the PCR has moved towards the upper end of the range. Normally at around 1.6 is where you see the markets cool off a little bit because that's telling you that put writing is becoming very, very easy. So from around 1, it's bounced up to around 1.45. And the FIs as well did write a fair number of puts in yesterday's trading session. And that perfectly ties in with the kind of action that you're seeing. 26,000 put, 26,100 put. Between them, close to around 2 crore shares added there. And the premiums crashed out there, which tells you that the markets are bracing for higher levels now. And that 25,500, 25,800, that's the crucial support zone, which incidentally is where the 20 as well as the 50 DI comes in at. So bracing for all-time highs, till this range is protected, you'll have to back yourself that we're likely to see higher levels. And the Nifty Bank, that's the one that actually could lead the way because that's been the case. 60,000 is almost out there. 20 DMA, very, very deep, 1,000 points away from here. 60,000 on the cards. But I think the biggest positive yesterday was the breadth of the broader markets and the way that the mid and the small caps did come back. You'll want to see more of the same because the headline index goes to all-time highs, but portfolios will want to feel like we're at all-time highs as well. So let's take it from there.
Absolutely. And yesterday's cash market buying that Nigel was alluding to, it kind of excited me, but then you have to keep all the blocks in mind as well. So, it's skewing it because if you look at the net numbers and we are still negative for the month of November, that's the only spoiler in the party. Those FPI flows are still missing. They're not coming back in a consistent way. By the way, Asian markets are feeling rather good today. So they're taking over from that positive Wall Street close. And most of the markets are up and about. Very unfortunate events in Hong Kong, of course, this morning with that massive fire. So our thoughts and prayers. And hopefully the rescue teams get it under control. But aside of, that disturbing story, from a market perspective, things are up. Major markets like Japan are up 1.5%. Last I checked, Kospi was higher as well. So no problems there. So we seem all set for a positive open. Let's pull up the implied open, the GIFT Nifty, and see what that is suggesting. Just a matter of time, right? And if we get this 51-point sort of a positive start, then the gap itself is going to take us very, very close to a fresh all-time high. So it seems to be, well, shouldn't say a given, but seems to be a very high likelihood today. With that, let's move on to the equity call of the morning. JP Morgan says that Indian equities have experienced significant pressure over the past year, driven by a confluence of factors, which is anemic earnings growth, lower beta, and a lack of direct AI exposure. However, JP Morgan's Rajiv Batra now says that with supportive fiscal and monetary policies, recovering domestic demand, and broad-based sectoral growth, corporate earnings are set to rebound. JP Morgan forecasts MSCI India earnings to grow by 13% in calendar year 26 and 14% in calendar year 27. They also raised their Nifty 50 base case target to 30,000 for the end of 2026 and also reiterate their preference for domestics over exporters. So that's a very bullish sounding JP Morgan saying the Nifty is going to 30,000 by the end of the next calendar year. Okay, we'll get to our global guest in a bit, but let's tell you what's lined up on the show. Plenty coming up as always, and a lot of corporate commentary as well. At 8:35, the management of Sami Hotels will join in. We'll talk about industry trends. Second half typically very strong for the hospitality sector. So we'll get some details from Ashish Jakhanwala. At 9 o'clock, we'll have with us ICICI Securities' Prabal Sen to talk about the outlook for the oil and gas sector. Remember, everyone's talking about the potential peace deal between Russia and Ukraine, and oil prices have been cooling off, so we'll get some perspective. At 9:20, Invesco Mutual Funds' Tahir Badshah joins in. He's a market master of the day. Then we get back to talking corporates. Prestige Estates joins in around 9:35 to talk about the company's second half outlook. Yesterday you heard from Brigade. The company was very, very optimistic. We'll find out if Prestige feels the same. After that, a full discussion on the government's rare earth magnet push for India. Big incentives being announced yesterday. Will they be enough? Will it encourage miners to mine more of these rare earths and produce the magnets? Towards the end of the show, Lata will be talking to the Axis Bank MD and CEO Amitabh Chaudhary on the bank's outlook for the current fiscal and, of course, looking forward to the new one.
The other thing is Bitcoin is back above 90,000.
Yeah.
I mean, so 3.5% move, and it's something to kind of note. It used that as a risk sentiment. I mean, here in India, of course, I mean, the crypto markets are, they're not dead, but they're not alive. I mean, regulation is a little unclear, but globally, Bitcoin, of course, is a risk indicator more than anything else. Many would argue and say, well, now it's a serious asset class. Maybe it is. But for those of you who are watching in India, I mean, I think it's more signaling impact in terms of where it is going. There you go. We are back above. We hit about 82,000, but that's crypto for you, Bitcoin for you. 82 and a $10,000 move, just like that. We take a quick commercial break here. We're going to come back. Lots of stock-specific action to track our top 10 segment with our research team coming right up.
Welcome back. Well, as always, plenty of stocks to track. Qs overall are good. We've been telling you that, and the market could be hitting those magic all-time high levels today. That's the indication. Global Qs are supportive, Asian markets are up, and the implied open is suggesting we'll start 50 points higher, which will put us within striking distance of that level of 26,277. So that's the magic mark that we're looking out for. What about individual stocks? As always, there's plenty of news to track, so let's straight away get to it with our team. Guys, morning to all of you. So let's start with Sonal, who's watching out for a couple of real estate names. Sonal, tell us more.
Yes, Oberoi Realty, the luxury developer, has actually entered into a redevelopment agreement. This will be for a project in Nepean Sea Road. The total area is 4,706 square meters, out of which the sales component will be 1.18 lakh square feet. So the redevelopment business is heating up, the market is heating up, and Oberoi is a new entrant there. Brigade Enterprises, they have signed a lease deed for 4,859 acres of land for a period of 90 years with Electronics Technology Park. This property will have a developmental potential of 1.2 million square feet, will also have a grade A office and a hotel with around 200 keys. So some expansion plans on the anvil.
Okay, all right, Sonal, got it. So we'll keep those real estate names in focus. But let's go to Sudarshan. He's watching out for some names as well. So good morning.
Good morning, Surbhi. So I have Studs Accessories, which has reported Q2 earnings first result after the company got listed on exchanges on 7th of November. And it's looking a good set of earnings, especially on the margin front, the big improvement we have seen because of the fall in the raw material cost. So revenue was up almost 7%. EBITDA is improved by 13%. Margin has seen an expansion of more than 100 basis points. It has come at 19.2% versus 18.1%. Gross margin too has seen an improvement of almost 300 basis points. It has come at 58.4% versus 55%. On the capacity utilization, it remains healthy at 86%. Also, company is looking to expansion, and it's going to expand the capacity for two-wheeler helmets by 1.5 million units in the first phase, and that is likely to be done or operational by Q1 of FY27. So overall, it's looking good for Studs Accessories, and I'm going with green. Okay, all right. Thanks a lot for that, Sud. But it's time to get in Vinny then. She's here to give us all the stocks in the news. Hey, Vinny.
Hi, good morning. So let's start with Patel Engineering. Now, this one has received 2 letters of intents from SEDEX Engineering and Infrastructure Project. And this is mainly for some excavation associated work in and for the region of southeastern coalfields. So because of that, the value of the project is around 800 crores, as you could say, 798 crores to be precise. We're expecting green for Patel Engineering. Salsa Technology, that's another one we'll keep an eye out on. The company has received 2 contracts worth around 695 crores from RVNL. Both these orders mainly are related to some infrastructure for reduction of loss work that happens, and this is across the region of Himachal Pradesh State Electricity Board. It's by them, and the region of Himachal Pradesh around that is what it's covered in terms of contracts. So green is expected here. Asian Paints, we're expecting green here as well. The company's subsidiary in UAE has proposed setting up it's a second paint manufacturing facility in UAE. The investment for this is around 340 crore rupees, or in AED, it's 140 million AED. So keep an eye on that one. The capacity will be around 55,800 KL per annum. So important update in terms of capacity expansion for Asian Paints. Lastly, Leela Palaces, that's also in focus. They're making an investment in Sofitel, the Palm FZE. The Sofitel, the Palm FZE is a owned beachfront hospitality property in Dubai. They expect to recover equity investment within a time period of 3 years. So an important update there, and obviously green expected here as well.
All right, Vinny, thanks very much for that. Well, J&K Bank and Paytm are 2 other names we want to focus on. And Gaurav has got details on these. Gaurav, morning.
Well, yes, for J&K Bank, they have got approval for fundraising up to 1,250 crores, and 750 crores out of this amount will be via QIP. Now, if you look at the numbers, it is something that we should be watching out for, because if you look at CET1 ratio, it is already at 12%. If you look at the guidance, management said that in FY26 they will grow their advances almost by 12% versus what we have seen at around 9% in the last quarter. And at the same time, if you look at price to book, now it is still below 1 time. So that is something that is really interesting to see, because they have not launched this QIP yet, they have just gotten approval. Other than that, for Paytm, sentimentally green, and the reason being that RBI has now granted a certificate of authorization for Paytm payment services. Now, if you go back in time, just in August, RBI had granted in principle approval for the same, and at the same time they advised the company to conduct system audit and submit the report within 6 months, following to which this in principle authorization will lapse. But it seems that Paytm is actually complying with all the requirements which were given by RBI. Other than that, if you look at any material impact, earlier also management had reiterated that this the onboarding of merchants, online onboarding of merchants, that stopped in November 2022, and even back then company said that there will be no material impact because this was specifically to the online merchants. In fact, if you look at the numbers in second quarter FY26 itself, the merchant count is at 1.37 crores. So not material impact, but definitely it can be a positive, because it can now onboard long tail and smaller merchants, and that is the reason why going green on Paytm today.
Okay, all right, Gaurav, and please take care of that throat. You know, a few days to the big wedding, and I'm sure the lucky girl will want you to sing a couple of numbers for her. So please, take some rest out there. And thanks a lot for that quick analysis as well. But let's go across to Vivek. The long-awaited deal is finally seeing the light of day. Some movement on that front. Whirlpool, the promoter, is going to be coming in there and selling some stake. Vivek, tell us what all you've picked up.
Well, that's right. So last evening, there was a block deal that was launched by the parent in Whirlpool India. So what's actually transpired is that, Whirlpool Mauritius, which is the promoter entity and held a little over 50% stake in the company, is looking to pair another 7.5% of total equity, which amounts to more than 960 crore worth of shares that is expected to exchange hands. Now, what is the troubling part is the fact that the floor price is almost at a 14.2% discount to yesterday's close at 1,030 rupees a share. Not only that, there is also a 90-day lockup on further sale of shares. But there are a couple of caveats, that the term sheet mentions in case there is another corporate action that may happen. But despite that, going with a red, promoter entity continues to pair its stake, and this time around the stake will be sold, or at least the floor price for which the stake will be sold is significantly lower than yesterday's closing price.
Promoter entity, as of September, had 51% stake. So today, in all likelihood, they sell another 7.5%.
The buyers will be very interesting, post-market us, because we'll have to see how that goes, whose hand it goes into, because we know that the promoter wants to sell. And
Yeah.
valuation-wise, I think it trades at 2x sales on a PE basis as well because of this overhang. So as this gradually gets absorbed, it'll be interesting to see. 90-day lock-in though after this. So keep that.
And also, there's been so many stories over the last couple of months who the buyer is.
Yeah.
And, there was some serious buzz that CG perhaps is in the race, and some large conglomerates perhaps also. So it'll be interesting, and we'll have those names later today.
Yeah, and ear to the ground, I was, I heard a couple of other large conglomerates, which I would not want to name, and a lot of PE interest as well. But they're going by the block route, so we'll see the buyers.
When we quizzed a lot of these, large groups who are listed, obviously, they all sort of didn't put it out there clearly, their intent. But I think the reality will prevail today once we have the details of that block. But for the time being, let's quickly recap our list of stocks to watch. The ones that have positive news flow around them are Oberoi Realty, Brigade Enterprises, Paytm, Studs Accessories, Patel Engineering, Asian Paints, Leela Palaces, and Salazar Techno. Stocks with negative news flow would be Whirlpool because of the overhang of this block deal. J&K Bank could see a mixed reaction in trade. That's our stock list for the morning. Let's now find out what's happening in the world of commodities. We have Manisha joining in with the latest. Manisha, good morning.
Morning, and thank you for that, Surbi. I'll start with the metals as a space because this really seems to be doing quite well. What with the dollar 9.5, which is a 2-week low flat one, and the market's pricing in an 85% chance of a 25 basis point rate cut in the month of December. So you have gold and silver trading at a 2-week highs. The copper price is trading at around 2-week highs as well. This is going to be a 4th monthly gain for gold and silver both, where we are looking at gold up by nearly 6%. November, and silver is up by 13%. Copper seems to have done quite well as well. We are up by 8% for the month of November for copper as well. What is not doing well is the crude oil prices. There is OPEC Plus gathering this weekend as well. And then the investors are watching the ongoing Russia-Ukraine peace efforts. Crude is on track for a 4th monthly decline for the month of November, and 60 isn't been able to hold when it comes to the WTI crude prices.
Okay, all right, Manisha, thank you very much for that quick wrap-up. So crude prices on the radar. As always, we'll take a break on that note. On the other side, we'll be connecting with Dipan Mehta, talk about some individual stock ideas for the day. And also, as promised, the management of Sami Hotels will join in to talk about trends for the company and the industry in the second half, which is seasonally, of course, the stronger half for the hospitality sector. Welcome back. Well, we've been telling you it's a pretty good-looking screen across Asia. Cues are positive, and the market could be in for fresh all-time highs today. So that's the overall backdrop. Let's pull up the implied open again and see if it's still up about 50-odd points, because that's what the indication has been so far. Well, while those rates come up on the screen, let's introduce Ashish Jakanwala, Chairman, MD and CEO at Sami Hotels. Lots to discuss, lots to talk about. Ashish, great to have you. It's generally a good feeling, right? Markets also started moving higher. Then we're in the festive season. End of the year is coming. And this is a good season for you folks. It's the best time for the industry, right? The second half. So first, let's start by understanding that this whole, GST implementation, whatever changes that had to happen, especially I'm talking about your mid-scale hotels, not the upper ones. There any pricing tweaks, GST adjustments, I'm sure all that is done and out of the way now. So where does it leave you, and what's the outlook for the overall portfolio for H2?
Surbi, thank you for having me. So absolutely, H2 is always a great time, minus the Delhi pollution. So that's a dampener. But I think it's been a great run since Diwali. We've had an unprecedented November in terms of performance across hotels in India. So I expect that to continue till pretty much the end of the fiscal year. In terms of GST, you're absolutely right. I think while at a broader level, the reforms are fairly beneficial for boosting demand. But I think for the mid-scale, it was a dampener because of the removal of the input tax credit. So I think that is something that we would expect the government to reconsider, because it kind of negates the whole impact. But generally, H2 is very strong. Demand is strong across India from all sectors. So that's very heartening to see. But I think some of these irritants need to be removed now for the industry to continue to grow.
So, Ashish, give us some sense on occupancies. How was the Diwali season, around that festive season, and what's your sense? Some ballpark range estimates will help as you're looking at Q3 and Q4. And you can break it down maybe in terms of the mid-scale and the upper-scale hotels.
So, Survi, first of all, I have repeated many times over that it's not about the segment, it's about the cities, So if you're in a strong market, all segments outperform. And if you're in a slightly weaker market, then all segments will suffer. So I'll repeat it again that the whole story is about location. It's not necessarily very segment specific. But coming back to your questions on capacity utilization and occupancy levels, we operate mostly a business hotel portfolio today. And we have seen occupancy levels remain in the mid-70s, largely because while Tuesdays, Wednesday, Thursdays are sold out, we continue to see a slight dip on the weekends and also on extended holidays. But occupancy levels have been really strong. But what's been really, really good is because capacity utilization is its peak. And why do I say peak even though we are at 75? Because Tuesday, Wednesday, Thursdays are all sold out. And that has allowed the sector to reprice itself quite substantially this year over the last year, in the last 2 months. So overall, total revenue growth continues to be, as I said, extremely healthy in this year compared to the same time last year.
Right. Good points there. Ashish, morning. I was just looking at this is a more stock market question, and I know you'll say, well, we all look at the business. But Sami's, you've deleveraged quite a bit, right? In a very, very fast time span. Finance costs are down quite a bit. Just in terms, if I look at Sami and where the stock is trading compared to peers, trading at a deep discount. What is the... From an investor point of view, Ashish, you'll continue to deliver, execute, and you'll use the savings through low finance costs to expand some of this, to fund some of the expansion. What should we expect as we head into 2026? This 2025 has been about a sharp reduction in finance costs, deleveraging.
Prashant, so I would repeat expressing my inability or incompetence to decipher the stock markets and how they price. But I have always told some of the large investors that you decide the multiple, I'll decide the EBITDA. And I'm quite confident as to where the company's EBITDA would be in the next few years. And that pretty much determines the path to value creation for our shareholders.
So,
yeah.
So
what's the EBITDA target? Yeah, since you mentioned just you decide the EBITDA.
So I think Nigel, you're absolutely right. We used multiple events over the last 2 years. First, the public offering. Then the partnership with GIC. The growth has been pretty substantial in our portfolio. Even the same store growth has remained at or above industry levels in the last several quarters. Going forward, we expect growth to continue to feed growth of EBITDA while our debt remains mostly constant. So net debt to EBITDA will continue to sharply fall over the next few years, even without any external capital interventions. So I think from a balance sheet perspective, we are sitting very tight, very, very healthy. In terms of growth, as you know, we've made some acquisitions over the last 2 years. We are well set to open the W in Hyderabad sometime next fiscal year. That will be an iconic hotel in the heart of Hyderabad. We have a Westin coming up in Bangalore in Whitefield, again, a great location. Recently we announced resolution of the issues at Navi Mumbai. That would be a single largest hotel, so 700 rooms at Navi Mumbai.
Ashish, that is, absolutely. My question was, so you said, right, I mean, a market decides the multiple, I'll decide the EBITDA. So give us some sense. I mean, how should we think about this? 26 is over, 27, 28, yeah.
So I think we'll continue to see EBITDA growth in the zip code of high teens to early 20s. That's what we expect the EBITDA growth to be. And that's really two components to that. One is same store. We expect to grow around 13-14%, same store EBITDA growth. And then really is the contribution of the new assets of the inventory. So that's what I expect as a very reasonable conservative estimate of EBITDA growth in SAMI, even if we stop deploying any capital, which is really not a fair assumption. So I think we will continue to see high teens to early 20s EBITDA growth for the next several years.
High teens to 20%. Got that, Ashish. So as you scale up, what happens to the margin profile? Because in the past, you've mentioned that the upscale share in the portfolio will probably grow to about, I think you said 60%. And just revisit the timelines as well. You mentioned, for instance, W opening up and a couple of these marquee properties opening up. So what is the share of upscale right now as we speak? When does it scale up to 60%? And then I'm guessing it really pulls up the margin profile, right? So give us some sense on that. You're at about 35% margin now, EBITDA margin.
Yeah, so we are right now at about 42% share of upscale in our total revenues. We would see this go up to 65% in the next 4 years. Now, the whole transformation happens every single year. So every year you will see this 43% upscale proportion grow. Next year when we open the W. This year also we've added inventory to our upscale in Sheraton Hyderabad and Hyatt Regency Pune. Next year we open the W in Hyderabad. A year after that, we have some of the conversions happening to upscale. So I think you will see almost a linear progression from now till, let's say, 4 years from now, 42 to 60, 65%. And I think we'll stabilize around 65, 70% upscale. In terms of margin, we expect right now we are at about 37, 38% reported EBITDA margins. We expect this to stabilize around 40, 41%. We need to bear in mind that we do some assets on variable leases, which are 60 years, only revenue share with no minimum guarantees. And because of the Indian accounting standards, that rent also gets added to the operating expenses. So otherwise, net of that, we would have been about 42, 43%. Otherwise, reported would be about 40, 41%.
In terms of your association with GIC and that JV, is there any plan to transfer more assets to the JV? And how are you thinking of, just that partnership going ahead?
No, listen, I think it's a phenomenal partnership, great partners. We definitely intend growing the partnership. We're currently looking at some M&A opportunities outside. That's really our priority. In terms of whether we need to or we want to transfer some existing assets to the joint venture, there's no such current plans, but it's always an option available to both NGIC to discuss. But at this point, our focus is to really secure some external opportunities for growth.
All right, Ashish, we'll leave it there. Thanks very much for joining us. Good speaking with you, and thanks for being here. Sami Hotels in focus. Deepan Mehta is with us with what he'd want you to do as we begin a new session. Director, Elixir Equities. Deepan, good morning. Great to have you with us here. Thanks for joining us. New highs aside, and we'll see when it happens. Don't want to preempt and jinx it. But Sami, if you have a view, I know you have a view on hospitality. I was asking Ashish, he said, well, I'll set the EBITDA, multiple market will set. Market multiple is quite low, 12, 13 times EV EBITDA, compared to a Leela or many others. What's your sense? Have you looked at this one?
Good morning, Prashant, and thank you for having me on your show. Yeah, I think that it's a very nice, piece of statement he made. And many other management should try and use it as well, because clearly that's what's under their control. The valuation is not in their control. That's fine and acceptable. And I think it's a decent company and reasonably good track record. And I would remain invested in a company like this. Its valuation is lower than a lot of its peer group valuations as well. And overall, we are quite positive on the hospitality industry because of, I would say, there is still a demand-supply mismatch in favor of the hoteliers. At the same time, I think, the way the wedding season are shaping up year after year and the way travel and tourism is picking up, I think the industry per se has a very good future. So I would remain invested in Sami. And I do agree that there's scope for the valuation multiples at Sami to move up as well. And I think almost a 25% type of increase in capacity certainly will ensure that the earnings momentum remains pretty strong.
Okay, all right. Got that. Deepan, hi. Good to be speaking with you. So let's talk about the durable space, because we're expecting a block deal to take place today, right? It's going to be a big one, lots of excitement, Whirlpool. Now, we don't know if any of the other listed incumbents, whether they'll want to, participate in this at all. But overall, how do you find this space? Any preferences? Yes, just yesterday, the gentlemen in the studio were having a very, invigorated discussion on air purifiers. So clearly, whether it's coolers, ACs, air purifiers, demand is always there. But from a stock perspective, anything you like?
Good morning, Surbhi. Yeah, I think it's a great industry and a lot of investors have recognized the long-term potential of the appliance and durable industry per se because of low penetration levels. But look, valuations are very rich. And I think that within the space, LG Electronics certainly is a company to watch over there. Last quarter was not that great and for reasons that we all knew about. But I think if it is able to sustain industry-leading growth rates, it should trade at a premium to Voltas and Blue Star, which it is not at this point of time. So there is a good potential I see in LG Electronics. Having said that, it's a company in which we are intending to invest as a measure of disclosure. And then you have to look for pockets of greater under penetration, like Eureka Forbes, which is into very niche spaces. excellent track record, and change of management has led to a new growth phase within the company. Again, valuations are rich, so you have to extend the horizon of the investment. But I think on the whole, one should remain pretty much overweight within the sector. Another company which comes to mind, which has disappointed big time but has got good potential, is Symphony. And all Symphony requires is one good, or rather one very hot summer, and you will see the earnings almost double or triple also from these levels, and valuation multiples also expanding. It's a company in which we and our clients are invested in. So I think that as a sector, it's great, but you have to find pockets of undervaluation or extraordinary growth.
All right. Hi, Deepan. Good morning. Good to see you in. And for Eureka Forbes, with regard to that point on air purifiers, I think it's less than 4-5% of the total mix, but there's a tremendous potential. And I was going through the presentation that they put up. The industry size has moved from around 180 crores closer to around 280 crores over the last 6-7 years. But they're estimating it goes to 750 crores by 2030, growing at a CAGR of close to around 18%. That's about the industry. We'll try to get a couple of managements as well and discuss this in further detail. But Deepan, let's turn our attention to the rare earth mining opportunity. We have a scheme that's come yesterday that is for magnets. And that will be, if you look at the value chain, first there is, there will be some mining, then there is a little bit of oxides, and then you have the magnets. So as of now, there's no big listed player that's doing magnets, but the scheme has come about which could help the value chain itself. GMDC ran up yesterday. However, just to tell our viewers that these benefits will come only in the next 4 to 5 years at the earliest. What's your view on a stock like GMDC? It's not for the faint-hearted. It was 650 rupees in early October. Then it corrected to 480 rupees. But yesterday, post that exclusive news piece that we put out from our sister channel CNBC Awaaz, the stock did spike up. What's your view on it?
Yeah, good morning, Nigel. I think from time to time, GMDC has shown its intention to get out of the typical coal lignite mining into more value-added, higher-value products. But I don't know whether that strategy or whether that plan has fructified per se. And as such, as you said, there's no play which comes to mind at scale where you can play this rare earths or magnet investment theme. So from that point of view, I think, you just cannot buy GMDC on the basis that, India intends to manufacture more of rare earths or do more mining. So I would say that a large part of the revenues do come from traditional businesses. And end of the day, the track record has not been that great of GMDC. It's been around for a long time. I don't think that they have sustainably increased the volumes also, as some of the other metal companies or mining companies have done. And at the same time, I think, I think it's reasonably valued. I mean, if you want to go for a mining company, then there is Ashapura Minecam, which does all different types of things. And then there is Lloyd Metal also, which has grown phenomenally over the last few years because they were able to crack a particular iron ore mine. And then there are the actual metal and steel companies which are going more and more to backward integration. So from that point of view, I think there's no play on rare earth. And when it comes to pure play mining, I think there are better stories.
Okay, better stories. Got that. Thanks, Deepan, for that. Stay with us. Let's hop across to Sudarshan. As always, wakes up early, goes through a lot of brokerage calls. He joins in and gives us a few of them. So take it away.
So I'll start with Kotak Institutional Equities, which has initiated coverage on Urban Company, recently listed company, and that has seen a sharp fall from the 52-week high. 52-week high, if you remember, it was 201, and from that to it's down almost 30%. Now Kotak Institutional Equities expects a further fall, and fall can be of 13% if you go by their target price of 120, and the call is sell. It has factored in a steady 17% net transaction value CAGR for India consumer business. And for international business, it has factored in 33% CAGR over FY25-28. It believes that India consumer services business can post adjusted EBITDA CAGR of 38% over FY25-28, but Insta Health business will require further investment. HSBC has upgraded Bayer Crop Sciences to buy, and target here is 5,200. It believes that company can post an improved results in H2 of FY26, and that can be aided by new product launches. Also, upgrade the stock as worst is behind, and valuation too it finds attractive. Valuation is at 29 times FY27 EPS, lower than the 10-year average multiple of almost 32 times. Jefferies has returned on PV Fin that we known by policy Bazaar. It maintains buy call and target here is 2100. It says company has indicated that premium growth will continue to sustain, and that would be around 30%. And despite recent GST changes, company expects take rates to stay stable, and premium growth and operating leverage will drive profit and cash flows going forward. So here also positive note for Policy Bazaar.
Okay, all right. So thanks very much for that. So Urban Company, PB Fintech in focus. Well, we'll take a quick commercial break here. We come back with Sudarshan Sukhani and Mitesh Thakkar on the other side for some technical trading ideas. Stay tuned. Coming up. Okay, welcome back. There's 13 minutes to go for the pre-open session. News at the bottom of the screen, and we'll put more context to this. We had reported, there was a CNBC-TV18 exclusive, that Cartrade was in talks for a potential acquisition. And this is just, 3 weeks back, right? That there were initial and preliminary discussions with Girnar Software, which is... car dekho, bike dekho businesses in India, which is also a very large player, competitor to Cartrade. And, the news was confirmed by Cartrade. And now at the bottom of the screen, Cartrade acknowledging that they've been in talks, but both parties have decided to walk away and there is no deal at this point in time. So the transaction is not being pursued for now. That is what's coming through. Stock, by the way, I think from the point that we reported the story, I'm not sure what the stock's done recently, but it did see a big spike in the immediate next few sessions after we reported that. I don't know if Deepan is there with us. Maybe I can just quickly ask him to comment. Deepan, are you there?
Yes, I'm right here. Yeah.
Cartrade, any thoughts?
No, I think it's an exceptional company, and I'm really quite sorry I missed it. And it's a classic example of how a platform company, when it consistently grows its revenues, doubles, triples, suddenly starts making solid profits. When you look at the last 5-year, 10-year history of Cartrade, it was consistently making losses. When it went public also, it was just about breaking even, no serious money. And now a couple of years down the line, when revenues have moved up, it is solid into black. So this is typically the way a platform company evolves, and that's the journey. And nobody could visualize when it was, 1/3 its price, that this is the potential and this is the kind of profit that it can generate. So it's a template for how we should analyze and invest in platform companies.
Hormuz tells us that Cartrade is up 10 times from the 2023 lows. Oh boy. So that's just amazing kind of move. Even from an extreme, that's exceptional. And of course, fundamentals have backed it, a platform company, and of course started throwing a lot of cash out. Deepan, stay with us. Hormuz actually is with us, right, with the big movers from yesterday and what lay behind the price action with some of these. Hormuz, take it away.
Morning, Prashant. Natco Pharma, we spoke about it during closing yesterday. As the kind of volumes that you saw on the stock yesterday was very, very strong. Along with the price action, the stock was up almost 10%, yes. But if you take a look at the volumes, they were the highest since April. They had almost 2 crore shares that were traded on Natco Pharma yesterday. The 20-day average is only 9.5 lakh shares. But out of those 2 crore shares, only around about 18 lakh shares were marked for delivery. So less than 10% of the shares were marked for delivery compared to a 20-day average of 3.2 lakh shares. And the stock has closed above its important levels, the 100 DMA as well as the 200 DMA. So the important technical levels, the stock has closed above those. Best Agro Life was a 20% upper circuit in yesterday's session, the biggest single-day gain since April of last year. The volumes in yesterday's session for Best Agro Life were the sum of the last 50 sessions put together. Now, of course, the stock was in upper circuit, but could have had much more volumes than that. 16 lakh shares were traded, 20-day average of only 31,500, and out of those 16 lakh shares, 2 lakh shares were marked for delivery. Here too, the 20-day average is only 18,000 shares. But it's been an underperformer this year, down around 45% from its 52-week high of around 660 rupees and down 40% this year itself. The SMS Pharma was a news-driven move in yesterday's session, a 17-18% up move, the biggest single-day gain in the last 5 years for the stock. Volumes on the were the highest in 3 months as well, almost a crore and 20 lakh shares traded yesterday. 20-day average of just around 6.2 lakh shares. So only 10% here too were marked for delivery. Only 11 lakh shares compared to a 20-day average of around 1.2 lakh. And Wednesday's turnover close to 350 crores, almost 40% of the free float market cap. And lastly, Fino Payments Bank, Wednesday's volumes was the sum of the last 46 sessions put together. 1.5 crore shares traded, 21 lakh shares marked for delivery, but the stock is down 50% from its IPO price, is Fino Payments Bank.
Okay, all right. Thanks a lot for that, Hormuz. Well, the other big focal point, that we're going to be looking at is the rare earth opportunity. And the cabinet post-market hours approved the 7,280 crore scheme to promote manufacturing of sintered rare earth permanent magnets. The rationale that they put out was to promote rare earth permanent magnets ecosystem on the whole. So a couple of points out there. One is they're looking at us being self-reliant and positioning India as a key player in the global space. The other point that they made was that they're looking to strengthen the supply chain for automotive, defense, as well as aerospace sectors. These magnets ultimately find their use in these industries. And India's, REPM, which is the rare earth consumption, is expected to double by 2030 in comparison to today. And currently, the entire requirement is met via imports. So we become self-sufficient in that case. At the cabinet briefing, we had Mr. Ashwini Vaishnav, who said that India aims to become self-reliant in rare earth magnets in the next 4 to around 5 years. So just keep that in mind. And a couple of other points. Remember, the chain is rare earth mining to oxides, to metals, and then to magnets. So this scheme basically is focusing on magnets, which is downstream in nature, but it will encourage miners to focus on the rare earth mining as well as on oxides. So the results will be 4 to around 5 years away. But one play is GMDC, because they have been focusing on the rare earth opportunity. And that's why we saw a big spike up in the stock. But the benefits will come in only in the next 4 years or so. And this scheme is for magnets, which is the downstream product, the end product, while they will be focusing more on the mining part and the oxides part. So that's a stock. Keep on the radar. Core business has been weak, but the street excited with regard to the opportunity. We'll try to get the management as well in the next 10 days or so on the channel. Well, let's get back to the markets then. Technicals, let's focus on. Sudarshan Sukhani of Technical Trends as well as Mitesh Thakkar of Bonanza Portfolio join us on the show. Good morning, gentlemen. Good to see you all in. Today it appears like it's the day. Don't want to jinx it, but after 14 months, we'll be revisiting fresh all-time highs. Sudarshan, you go first. What's the call you're going to be taking?
Well, I'm very pleased. For the last 3-4 days, I've been saying we are in a small compression. We have to go long. We have to stay long. Our stops are there. And we have to, I've used the words, we have to suffer through this correction. And we have suffered through it. And the point was that when the market goes up, it will go up like a rocket. That happened yesterday. Now, today's trade, should we take it easy? I don't think the market will have the same performance that we saw yesterday. But the trend is up. We are likely to make new highs. And new highs invariably are bullish. So the trade simply is look for minor consolidations, dips, and go long.
Okay, so look for small dips and go long. That's the trade. That's been Sudarshan's trade for a while, absolutely. Mitesh, good morning. So how are you gearing up for what could be a big day?
Good morning, Surabhi. So I think, to me, the idea of getting past all-time highs is a question of when. It looks like that there are stronger possibilities today of making fresh highs and then continuing this upside momentum. So I think tactically the way you approached the index today is that try to take profits around this 26,250, 270 mark. And then if it starts getting past 26,300, that'll be a fresh trigger to take long positions with 80, 90 point kind of a stop loss. And then I believe that, breaking into all-time highs could see the markets on a small-term basis, a small-time basis, get past 26,500, but probably attempt a rally towards 26,900 to about 27,000. But yeah, let's not forget this 26,270 in between. So around 26,250, I would suggest people to lighten up a little bit. Good part of their position should be taken out and buy again if you see the Nifty get past 26,300.
Okay, and that's important to keep in mind that that's the goalpost. There's a decisive breakout, and if we sail past 26,300, then, as Mitesh says, then it's all hands, in. Gentlemen, stocks then. Sudarshan, what's on your list?
Well, it's an all-buy list, and since we are already long in the Nifty, it's better to focus on mid-cap. Zydus Life is a buy with a stop under 920. Shriram Finance, and I have positions in this as trading positions, is a buy with a stop under 840. United Spirits is a buy with a stop under 1430. And Dalmia Bharat is a buying opportunity with a stop under 1990. So there are 4 buys, all of them on the long side.
All buys for Sudarshan today. Mitesh, what about you? Stocks?
I have an all buy list as well. HDFC Life is something which I've been liking for quite some time. It gave a pullback. Yesterday was a big reversal and a bullish candlestick pattern. So buy here with a stop at about 775, just below it, and a first target of 810 should be looked at. L&T made a fresh swing high, so buy with a stop at 4030 for targets of 4140. Also a buy on BPCL, which after a few days of correction has pulled back. Keep a stop at 362. Look for targets of 378. And Coforge is something which I've had buy calls earlier as well. Now made a fresh swing high, so buy with a stop at 1852 for targets of 1910.
Okay, all right. What we'll do is we'll take a quick commercial break here. We'll come back in just a bit from now with the pre-open rates, and also we'll put the spotlight on oil, especially on the product side. Oil prices are down about 4% in the last 1 week. But there's, of course, a growing sense with the Russia-Ukraine war closer, perhaps, to ending, that diesel cracks and basically product spreads could come down sharply as well. We'll chat with Prabal Sen for that perspective on the other side. Stay tuned. Welcome back. There's 13 minutes, 45 seconds ticking down and counting down to the market open. Prabal Sen is with us, energy analyst, ICICI Securities. Prabal, good morning. Good to have you with us here. We had the GE Shipping Management with us, and it was not so much about a conversation about, it was basically about tanker rates, etc. I don't know if you heard it, day before yesterday. But we asked the management of GE Shipping what happens to product cracks, etc. And he said, well, they're exceptionally high. Diesel cracks $30-40, and you can see a substantial fall if the war in Ukraine ends. Your thoughts, Prabal, first up there?
No, absolutely. I think one of the critical issues has been the attacks of Ukraine on Russia's energy infrastructure in the last couple of months. If you look at the kind of refinery capacities that have gone offline, according to, I think, data from certain industry trackers, the overall global refining industry offline was somewhere around 5.5 million barrels a day. In August, that number went up to somewhere around 8.5 million barrels of oil per day in September, October. So obviously that has created a lot of supply tightness in specific products, and that's where diesel margins have really taken off. Having said that, what we've really seen is that in the last couple of weeks, there has been some normalization. At least data that we have suggests that diesel spreads are back to about $25, $26 from highs of $40 that they hit at the beginning of the month. So there is some normalization that's happening. If there is obviously a ceasefire or any sort of conflict resolution, which allows Russia to rapidly rebuild or, sort of repair its energy infrastructure and bring those capacities back online, you can probably see a little bit more softening that can happen and some normalization of those spreads.
Prabal, hi. I was reading a note from one of your peer brokers, and that seems to suggest that on the marketing side, margins have been coming off quite a bit for these three entities. I'm not sure what's led to it and whether it's a one-off. So let's address that. Let's just see. Let's get your sense on how you expect the refining margins to be, whether they can these high levels, whether they'll sustain. And then a word on the cool-off in marketing margins, and then we'll come to the overall picture in terms of what it means for OMCs.
So the way you've got to look at OMCs is to look at integrated margins at the end of the day. What has happened is that absolute prices of diesel and petrol, obviously, given that spreads have expanded, the absolute prices have obviously risen up quite sharply. That reflects partly in GRMs, but GRMs is essentially about just the spreads. But given that crude hasn't moved beyond a certain range, the absolute prices themselves have gone up. And retail fuel prices have remained unchanged. So retail margins collapsing or reducing is not that much of a surprise. That's just arithmetic. Having said that, as you rightly pointed out, GRMs, if you look at theoretical GRMs on a QOQ basis, our sense is that GRMs have probably gone up by around $3.5 to $4 for all downstream players at this point of time in this quarter. So even though blended retail margins and admittedly diesel is at close to negative levels, but petrol has still held on at about 6 to 7 rupees. So blended retail margins are down about 3.5 to 4 rupees a litre. The balance between these two still means that integrated margins are probably down maybe about 1 rupee a litre at best, against maybe close to 7 rupees that they did on an average. I'm talking about the three OMCs in Q2, to somewhere between 5.5 to 6.5 rupees in Q3 as of now. So the issue really is that as long as integrated margins continue to remain, fairly robust, just a reduction in retail margins is not something that, will worry us. This can easily, as I just mentioned, given that diesel spreads have started to normalize, absolute product prices can decline, and that can once again bring retail margins back to at least some semblance of normality.
So as of now, you're saying that integrated margins have not dipped too much, barely a rupee or so, give or take. So then, from a stock perspective, not talking about stock prices, from what you say, then stock prices don't seem to be at any risk of a sell-off. I mean, overall this year, calendar year, I think between which stock you're picking, the stock price is up 15-20%. So, short point, what should we do with OMC stocks?
No, I think we would continue to be positive. We really think that, at the end of the day, as I said, either, the GRMs continue to stay at these strong levels, which we believe is probably, a bit optimistic to think. I think there would be some normalization in terms of product spreads, but there is still supply tightness. There is still a lot of capacity offline that will take its own time to come back into the markets. So some tightness will remain. And at the same time, if crude continues to basically soften, and if news continues to, come through the off-conflict resolution, specifically in Russia, Ukraine, with the kind of supply surplus that's already there, if crude actually softens, then, the absolute product prices will also sort of really come off, and that can support retail prices as well. So our sense really is that consensus earnings or our base case earnings are not really at a huge risk. Yes, there can always be a downside of 5 to 7%, but even after the rally that the downstream names have seen, the fact is that valuations still remain at fairly comfortable levels. Add to that the LPG loss compensation, the reduction in absolute LPG losses for this year against the 400 billion expect to have just about 150 billion of loss in this year. And I think those two factors combined means that marketing earnings can still hold on slightly better than what the pessimistic outlook would be. We would remain fairly positive at this point of time.
Okay, so you're positive on all the OMCs. Not sure if you have a coverage on Chennai Petro, maybe throw in a word there. And Reliance, particularly now that Reliance has stopped buying this Russian crude, and apparently the discount has become as large as $6 to the barrel, just because Indians are not buying. Now, what happens to Reliance? And I'm talking, just the refining business.
As I said, as we have stated earlier, I think on your channel as well, that, if you do the math, even at 40% of crude, which was estimated at coming from Russia into Reliance's portfolio, and I have no way of knowing if that number is true, I'm just making a guess. But even at that level, if the discount earlier was at maybe about $2.5 to $3, you had basically an effective impact of around $1 or so in terms of GRM. Against that, the base margins itself are now up around $3.5, $4 plus, if not more. So, frankly, at least in Q3 and Q4 earnings, even without Russian crude, you're likely to actually show an increment QOQ in terms of your OTC segment earnings. So our sense would clearly be that against the 15,000 crore run rate that they showed every quarter in the first half, second half earnings are still going to be, materially higher if these trends holds, irrespective of whether Russian crude is coming through or not.
Okay, and of course, standalone refiners, will be the worst hit, right? Prabal, as we saw in Chennai, but they've also had massive runs this year.
Again, it's a question of crude cost hit versus the absolute product spreads in terms of how they line up. We don't really cover CPCL and MRPL specifically, but theoretically the same argument holds in terms of where the margins are versus what the crude cost is.
So one name is if you had to buy in oil marketing, what is the top idea from here? Where there's downside is limited.
We would still look at HPCL at this point of time. I think their refining to marketing mix is improving all the time. That provides a natural hedge against volatilities between the two margins. I think they will add a significant amount of decent petrochemical capacity. Leverage is going to continue to go down. And, marketing losses from LPG are also something that are not really a factor at this point of time.
Okay.
We would keep looking at that name.
All right, got it, Prabal. Thanks very much. That is very nicely explained on why Prabal is not too worried about this fall in marketing margins and how the spreads are moving up from here on. He's still quite optimistic. Doesn't see at a blended margin level basis, he doesn't see more than a 1 rupee hit, if at all, on some of these OMCs. Okay, the pre-open has settled and it's 26,261, which is, well, just 15 points, almost 15, 16 points away from that mark. But we'll see. It'll happen when it happens. For the time being, let's go back to our experts for some final trading ideas. Sudarshan, what's your call?
Well, it's United Spirits. Buy United Spirits with a stop under 1430.
United Spirits going for the high today. Mitesh, what about you?
I'll go with the buy on HDFC Life for targets of 810.
Okay, HDFC Life. Got that, Mitesh. Thanks very much for joining in. Let's get to Sud. He is watching out for a couple of stocks. I think car trade is on the radar. What makes it to your radar, Sud?
So it was November 10 that when we had reported that car trade is looking to consolidate the automotive business by acquiring to Car Dekho and Bike Dekho, and was in talks with Girnar Software for that consolidation of automotive business. So it was expected to help, or it was a positive development. And November 11 company had confirmed our news break. But now there is a latest update in which car trade is saying that car trade and Girnar Software have decided not to proceed with that consolidation. Remember, this year the stock has almost tripled. It's now up more than 113% 2025. So how will this new development be taken? It might be taken negatively. Why? Because if this deal would have gone ahead, this would have given the company bargaining power with advertisers. Also, it would have helped and basically benefit or improved incremental revenue per ad spend. So ad spends would have gone down and revenue would have improved. So that might be taken negatively, but it's indicating that stock is opening flat.
Okay, all right. Car trade is absolutely flat right now, 3177. We'll try and get in touch with the management for a conversation as well as we go along. Urban Company, the brokerage call coming through from Kotak. Mangalam is here with that one. Mangalam, take it away.
Well, another one to the list of underperforms for Urban Company when it comes to initiating coverages. And this one comes in from Kotak. They have an initiate with sell, a target price of 120 rupees. While, they believe that the overall net transaction value can compound at around 17% for the India consumer services business. They see a higher growth prospect in international business on a low base can compound at 33%. And consumer services business post-adjusted EBITDA can actually compound at over 38%, indicating operating leverage. So what keeps them on tenterhooks when it comes to their call in the stock? It is the investment that would be required in InstaHelp. Remember, even in the quarter that went by, the company reported a loss only because of increased investments in InstaHelp, which is basically the quick commerce version of Urban Company's services, which the company believes is a large total addressable market, but they will have to continue their investments there. So until there is clarity on that, maybe the brokerages are slightly cautious.
Okay. All right. Mangalam, thanks a lot for that. By the way, guys, we were talking about fresh all-time highs, which is great news. But the Nifty Next 50, that is close to around 6% away from all-time highs. And the small cap index is 9% away from its 52-week high. So the breadth of the market really needs to come into play, I think, so for portfolios to feel good. And the other one I think we're looking at is the large trade on Whirlpool. It's opening up gap down. I think our sister concern is, picking up that the size can, the block size could have been upscaled. I think that's what's coming in there to around 11% from around 7.5%, which will be even more interesting. I was expecting a green shoe option yesterday when I saw the book, and it wasn't mentioned, but now it appears that that block size has increased.
Names will be interesting.
Very important.
We'll look at it as we get the details. I think we're about very, very close to market open. 9:13 is where we are at, and then we'll pick it up from there. So 56 points higher, 26,261. And I would say let's get it done, right? The new all-time high. So just quickly sort of be wrapping up the stocks in focus as well, right? Oberoi Realty will come up, should come up, and 1%, Brigade, Paytm, 1.5 each there on those two. Studs, which is a helmet company, about 0.7%, accessories company. Patel Engineering, Asian Paints, so 7% on Patel. A big one, right? Big order there. Pidilite, Salazar Techno, and, of course, Whirlpool was down sharply. There's a very large block there. And, of course, J&K Bank is the other one, which is coming up. So, yeah, I mean, you've got two large movers. One is Whirlpool, the other is Patel. One up, one down at this point in time. So, that's the picture as far as the market open is concerned. So, will we have a new high right at the word go? And will we put it out? We will put it out if it happens. But should be done, right? 26,261 on the Nifty. The Nifty Bank is up about 0.13. The sensex is up 0.16 and 0.29 on the small cap index. And there we go. After the races, 26,242. Alas, I mean, a little. It's kind of flattish, right? Right now, 26,221. So absolutely flat out of the gates. Absolutely flat. 18-point change. Nifty Bank is 59,580. Mid-cap index is absolutely flat. The small-cap index will come up on your screen as well, and we'll pick it up from there. I think the Nifty 50 heat map gives you a quick sense of where we are landing in terms of market open across the 15 large-cap names. And it's basically more up than down, definitely. Hindalco, Geofin, M&M on one end, and you've got HDFC Life, Maruti, Titan on the other side of the spectrum. So, there's a bit of a buoyancy, as you can see, 26, 244, 41, 40, 38. So, dancing around. Surabhi.
Teasing. But anyway, it's an assortment of stocks, really. Not too clear in terms of trends. Hindalco is up and about. There's L&T, there's M&M. M&M, by the way, is launching, an EV today, highly anticipated. I think it's the EV version of the XUV 700, so watch out for this one. Tata Motors passenger vehicle still continuing its good form with the buzz around the Sierra. 1% on that stock as well. Bajaj Auto is actually also up. So some of the auto names are looking good. ONGC, Bajaj Finance, Geo Finance. These are some of the early movers on the upside. Asian Paints about 0.5% higher. They're looking at expansion in international markets. On the downside, what's keeping a lid on the rise? Actually, no stock is falling too much. It's just the ones that are dragging their feet. For instance, Reliance Industries, absolutely flat, doing absolutely nothing. Let's check the other big boys. HDFC Bank, absolutely flat, no sign of move. ICICI Bank in comatose territory as well. And this is the reason why the market's not able to really make up its mind. ITC is up about 0.25%. Lever is absolutely flat. None of the big guns are firing. Let's check the tech stocks. Infosys, absolutely nothing, 1.5 rupees. TCS, totally flat, 2 rupees. So till these big boys decide which way they want to go, I don't think we're getting that close to the all-time high. So Nigel, the countdown is still on?
Well, that's right. The countdown is still on. A few stocks, though, from the broader markets that deserve special mention. You have Sterling and Wilson Renewable Energy. They have received the second South African project of around 1,300 crore rupees. Explains why that stock is up. You have another one, GMDC, the rare earth opportunity. That's the stock that's in focus, in today's trading session. Yesterday it was up, and today as well, seeing some follow-through buying. The gains will come in the next few years or so, but the street wants to price it in. Remember the stock, 650 to 550 now, even after the 10% move you've seen in the last couple of trading sessions. So that's another one on the radar. What else? I think you've already highlighted a couple of the other names that are moving around. Capillary Technologies yesterday as well, that came up as one of the top movers, and then it slipped from the top, but that one's opening up in the green. The dollar index has cooled off, so that's why you have metal stocks that are participating. Nalco, SAIL, they're all up in today's trading session. And GMDC, besides the rare earth opportunity, it also has this tailwind of being a mining-related play as well. Ashok Leyland is up another 2.5%. So pretty good start, but just waiting for a few more minutes, I think, before we hit the fresh all-time highs.
Okay, I think, we've got the broader market looking much, much better. So about 3:1, like yesterday. So 1,700 stocks are higher, and about 580 stocks are down at this stage. And it's a good-looking screen. GMDC, from the point that we put out yesterday, CNBC put out the story that the cabinet is basically going to take up the rare earth scheme for approval. This is in the afternoon. From that point, the stock's up about 10%. So it's been a meaningful move, 555 on GMDC. And we've got a discussion coming up on rare earths in a bit, in about 30 minutes' time. Excel soft is a listing from yesterday. It's coming up with just a 2% pop, but it's got very large volumes for this point in the day. What else? You got Sterling Wilson Solar 3% higher right now. Best Agro 11%. It was a very large mover yesterday and it's coming up with volumes right now. Ganesh Eco, the recycler, right? I mean, completely bombed out name, but it's coming up 8% yesterday, 8% today. You know, I think it was part of.
No.
Okay, I think I'm talking about. No, sorry, I misread it. Ganesh Housing is the one. Beg your pardon. Actually, the price is pretty similar, $900. 8% actually on this one. Yeah, that's the one. Ganesh Eco, the recycler, was the one which was on Nimesh's chatter list and of course did very well yesterday. But today it's of course kind of flattish. SMS Pharma was a big mover yesterday, 326. It's coming up with large volumes at this point in the time. Fino Payments Bank is the other one. Ended 10% higher, I think about 8% by close. But it's coming up. It's coming up with another, I think, 4% pop at this stage. So that's the picture. Whirlpool, of course, there's a large block, 10% lower. It's the number one volume-led loser at this stage, 1,077. Tahir Badshah is with us, Chief Investment Officer, Invesco Mutual Fund. Tahir, great to have you with us here. Thank you for joining us. You know, so I think we will get this new high done. But will that change sentiment, Tahir, a little bit for the better? You know, the written sell-side sentiment has changed on paper. Everyone is expecting a better year ahead, better returns, relatively speaking, after the tough year we've had, especially in broader markets in 2025. What's your sense, Tahir?
Yeah, I agree, Prashant. I mean, the setup is reasonably good at this stage. I mean, when you, all things considered, especially when we are coming out of a reasonably decent underperformance relative to many global markets around the world as well as emerging markets. And I think we've got, of course, you know, some of the macro starting to look a little better, especially given that environment for a further rate cut, both globally as well as in India, is starting to look relatively more brighter. And I think alongside which, last but not the least, and most important, is that we've got some earnings acceleration as well in this quarter compared to what we've been witnessing over the last few quarters. So I think all this, it's not still a cheap market, but it is, you know, obviously stayed in a place for a while and given you some kind of a time correction. So I think it just makes it a reasonably decent setup. And also from the point of view that, you know, globally, I think we have been an anti-AI trade. And if that is starting to kind of come about, even for a limited period of time, I think that just opens up a window for the Indian markets to probably do well over the course of the next 6 odd months, if not more.
Tahir, hi, great to have you with us. You know, you have been known as the mid-cap expert for decades. I mean, a knack for picking out those undiscovered stocks.
Fresh all-time highs.
Oh, it's happened.
Yeah,
sorry, Tahir. Sorry for that. It's finally happened. 26,280, 283. Nigel said it's going to happen in November. It happened in November. And this has been in the making for a long, long time. You know, painful wait going back to September of last year. Over a year, consolidation, the market testing investors' patience, but investors, and particularly retail investors, have kept the faith in a year where FPIs have sold off more than 150,000 crores of equity from India. But it's the domestic story that's gotten us here, and we're at all-time highs.
If you can just pull up the Nifty from September last year to now, I think it'll give you a great picture, basically, of what has happened. You know, in one snapshot, late September on, I mean, if you can pull up a Nifty chart, I think we have it, right? That's November on, but maybe from September on. So you basically hit this high on 27th of September 2024. And then you had it was a slow grind lower, just sort of recounting what happened. And then there was a sharp-paced fall starting March of 2025, which took us all the way down. I mean, the low in April, the Liberation Day low was 21,743. I mean, absolute, actually, at that point looked like panicky kind of moves. And 21,740 or so is the low in April. From there, a very, very sharp recovery in a few weeks to about 24,500. Spend some time there, 25,500 by about August of this year. And then the real painful sort of part began, because August onwards, actually June onwards, the market just sort of, went into a grinding kind of move before this latest impulse move started, which is, of course, early November. We were at about 25,400 and we moved up to, we basically moved up 1,000 points from that point on very, very quickly. As we've crossed those new highs, you're essentially, a lot more stuff is in the green now on the Nifty 50 pack, the heat map basically, as you saw. I think now, Nigel, the small cap index is the last one?
Yeah,
the
small cap index is around 8% away from its 52-week high. The Nifty next 50 as well, that's close to around 6% away from its all-time high. And just a quick point out here, right? We're talking about all-time highs, pulling out the champagne, things are looking good. We're getting into the end of the year. That's due, Prashant. That's, expected during the course of the day. But things are looking good. But just to give you a couple of data points, as you said, Prashant, we pull up the chart from September 2024 till date. We're just back at where we were. But I'm looking, forget about the broader markets, I'm looking at individual stocks. Trent, that is 40% away from the high that we saw on that day. Bajaj Auto is 27% away from those highs that we saw on that day. Coal India, another 25%. TCS, another 25%. NTPC. So I can see frontline Nifty names that are 25 to 45% away from those all-time highs. Champagne is being popped, but some people have not participated. No champagne, no good snacks, no music, nothing, no DJ.
That's why I asked Tahir, right? I mean, will this really change sentiment? Because actually, I think it rarely happens that the market hits a new high and sentiment actually is low. And you mentioned, Nigel, large caps. But if you go down to mid caps,
absolutely.
I think Nimesh is putting that piece out for ERT, Editors Roundtable, tomorrow.
Oh, lovely.
Looking at the Nifty 500 stocks and what, I mean, it's looking pretty bad. And I'm talking about names, not some two-bit stocks out there. These are stocks where there are large institutional holdings of, single mutual funds owning 7-8% kind of holdings. And where there was frenzy 6, 7, 8 months back, and it's kind of gone south completely other way. And I think that's the reason why, even though we are at a high, and I think we should acknowledge that we are at a high, and we are acknowledging, I think at a portfolio level, it doesn't feel like a new.
And if I were to put a guesstimate just to that Nifty 500, stocks, I don't think, even 300 of those stocks will be anywhere close to those highs. So just putting a guesstimate out there. So for the headline index, there's been a time-wise correction. But for the broader markets, it's been a price-wise correction. We live in hope that 2026 will be far better. And then, in fact, portfolios will gradually start to feel that they are part of the party.
And then we can open the champagne.
So for the mid-cap 150 index, we're about 4% away from that high. If you talk about, obviously, IT, has been the worst performer, has not really participated in this rally. So that's one area to look at. Even the defense index, which had such a stellar time, the April, May, June period, from the highs, even the Nifty defense index is well off, about 5-6% off those levels right now. So the rest of the market perhaps needs a bit of a catch-up. And Tahir, that was the question that I was coming to you with, actually. I mean, you're such an expert on mid-caps and small caps. So what's the feeling at this all-time high? And how should investors now go about refreshing their portfolios, looking at their portfolios? Where do you still see the opportunity of a catch-up rally?
Yeah, so clearly, I think where we have clearly lagged is as far as the broader market is concerned, and more particularly in the broader market, I think the small cap space is obviously something which is very clear, given its recent underperformance, and more probably from the point of view that earnings acceleration has not happened there, or earnings have actually been decelerating, in that space, and I would like to think that is a place which will probably start getting more attention as we get into a scenario where overall, at a system level, we start to deliver more earnings growth. And I think that will be the test. I mean, it's nice to see the new all-time highs, but it needs to kind of broaden, spread to the broader market as well. And I think that will call for this nascent earnings acceleration that we've seen in the last quarter to sustain into the next few quarters of calendar year 2026 as well. And that is when I think we will probably see, relatively stronger risk on sentiments compared to what it is.
So Tahir, I mean, I know, and when we're talking mid-cap, small caps, it's all entirely bottom-up, and I know you can't talk stocks. But in terms of pockets where you see some growth visibility coming back, and there is a nice valuation entry point as well, what will it be? Because again, I'm just going into sectors Defense, which was such a love theme, at an index level, it's about 10-12% away from the peak. FMCG, despite the optimism around the GST cuts, obviously hasn't moved. The FMCG index is still 6% away from the highs. Now, different arguments. Maybe, FMCG is not the best way to look at growth in the second half. But again, in terms of themes in the broader markets, which ones will you keep your eye on?
I think by and large, we've kept to the same themes more or less for the last good amount of time. I'll count out things like, healthcare has been one of our favorites, especially domestic hospitals and, some of the domestic pharma companies as well. Alongside which we have been very optimistic as far as banking and financial services, more particularly NBFCs to begin with, and now it is incrementally spreading to the frontline banks, both on the PSU as well as on the private side. I think we've always been constructive as far as the capital markets play is concerned once again, as a section of BFSI. So that's something which is not exactly, it saw a dip in terms of valuations, and valuations have crawled back up. But that is where growth still continues to significantly stay ahead of system rate of growth. Lastly, I think pockets of consumer discretionary, which by rotation tend to move from one pocket to another. But in general, that is a class which, given all the developments of the last some time, is something where we continue to kind of try to find ideas. Consumer fintech still remains our favorite across many of our portfolios, and that's right up there in terms of our preference list. Yeah, that's pretty much there. And I think IT is obviously been a value play, but it is starting to find its feet. And I think it is quite fair to assume that we will probably get into a bit of an acceleration as we get into the part of 2026.
Yeah. I just have a question. I know, Tahir, I know you can't talk specific stocks, right? But I'm just using GMDC as an example. Let's put it up. And we have a rare earths discussion coming up a little later. This is about the state putting its might behind developing a new industry, right? Now, GMDC apparently has the reserves, and I think Nigel has the numbers and he's been telling us, but it's a long story as we understand it. How do you think about something like this? Earnings are not going to come anytime soon, but here's the government which is sort of prioritized it as a national security industry. What's your sense, Tahir? Something like this, for example, what we saw with, say, railways a couple of years back, it was a different situation. Defense, for example. Now it's rare earths. Shipbuilding is another one. Any thoughts?
So some of these sectors do appeal, especially shipbuilding for that matter, and certain other infrastructure pockets, which are relatively more easy to, they're in our control, and essentially we're not looking at competition from outside. But I think some of the newer technologies or technology related, whether it is rare earths or whether it is even, EVs and so on, and everything to do with the EV ecosystem and so on. I think that part is still a long way to go. And, we don't really have many plays, or we don't have many vehicles to play some of those opportunities. Even I can understand the intent of the government, given the policies around the world. But we also, from an investment standpoint, need the vehicles, which we have in areas such as, other parts of the market infrastructure and, what are things that you called out, railways, ports, etc. But we don't have an adequate measure in some of the others. So I think that is still some time away. I think for us, India, it is basically the diversity that India offers. So that's why, as and when the attention from, AI becomes a little softer, and I don't expect even AI to go away anytime soon, but we get that window of opportunity where diversity comes about, and asset managers around the world start to rebalance their portfolios.
Tahir, before we let you go, our next discussion is on real estate with a real estate company, Prestige. We'll have Mr. Razak join in shortly. But I want to get your thoughts, because this is one more sector that's a little confounding. When you talk to the developers and when you see their numbers, and all of them have had an actually pretty solid last couple of quarters, right? Pre-sales have been good, collections have been up, pricing has either increased or has been stable, but the stocks have languished. The Nifty Realty Index is almost 19-20% off the peak. So what's going on here, and what's your sense on this part of the market?
No, absolutely fair. And I think that is another part which I forgot to mention is a reasonably important element of our portfolios as well. And we've lived through it. I think we've enjoyed the fruits of it as well 2 years prior. And the last year has been somewhat slack across the sector, but that's understandable after a very strong rally. But I think generally we feel that this is still a segment which where the growth cycle is relatively more sustainable. We've seen real estate generally has long cycles, as we all know, 10 years up, 10 years down. that kind of a thing. And we are probably still in mid-cycle zone. And we've a good part is that stocks have corrected. So actually, we will see momentum start picking up once again. There is we from a more longer-term standpoint, we believe that the biggest driver of real estate is essentially the fact that we're going to see a significant migration from low middle income households to upper middle income households. As you look at it on the income spectrum, and that is a once in a lifetime event in any country. In any country's history, and India is already in that process, but it is only going to get bigger and bigger. So we are going to see probably almost 20% households move from low middle income to upper middle income, and that is essentially what is going to drive a lot of the real estate demand. And we are also in the midst of an upgrade cycle as far as real estate is concerned. Everybody wants to premiumize as far as the housing is concerned as well. So I think it's relatively more sustainable, and especially in an environment where interest rates are make it more affordable. And so I would like to think that this is something which should come back. That is one of the sectors which we hope will be a cyclical recovery in 2026.
All right. Thanks a lot, Tahir, for joining in. Wishing you a good day ahead. And hopefully the next time we chat up, the broader markets will be participating as well. For today, we're celebrating the Nifty at all-time highs. Well, Prashant, just one quick point on what you said. The state government push, when the management push comes about, a stock like GMDC, for example, we here at CNBC-TV18 had explained the prospects in 2022, June. A viewer's, in fact, just written in. The stock was around 150 rupees. It had cash in its books, but the intent of the management wasn't there. And you couldn't reach the management for many, many years. Suddenly, you had a change in management. Mr. Gupta came in, Mr. Singh came in at the top as well, and that's where the fortunes started turning as well. So the intent to create wealth as well is something that's very, very important, and communication with the street is something that the street tracks.
Nigel, the point is, and I spoke to yesterday somebody, I think Nimish also tracks this one closely, and the point is, and I think it's still, you got to get this stuff out of the earth, right? Now, the mineral is, the stuff is there under the ground, you got to take it out, right? That's essentially the thing, and that's 3 years, 4 years out. Yeah. Now the point is, rare earth processing is a different matter. Yeah, that is a new industry you got to set up. Yeah, that will take time. Yes. So that, I think we've got a chat coming up, and we'll try and understand. But the point is, can this be fast-tracked with the centre now coming in and putting in a policy that we've got to develop this industry in a big way? I think that is the question for a company like GMDC, and we'll try and understand this, and we'll try and get GMDC, the company, on the channel once again. We'll take a quick break. 70 points higher, 26,275.
I think before we...
I think Hormuz is with us, right? Yeah. He's standing by. He's prepped the data on where markets are, stocks more importantly are, September 24, and where they are now, even though the index is back at those levels. Hormuz, take it away.
They say sabar ka phal meetha hota hai. It's taken 14 months long of sabar to get to where we were back in September of 2024. It's, of course, the record highs for the Nifty in today's session, and from the lows that we made this year, which was on the 7th of April, we are up 19% from those levels. You look at the stock contributors as well, among them, starting from the 27th of September. You look at Eicher Motors, BEL, both of them up over 40%. Bajaj Finance cooled off from the highs, was among the top gainers, still up 30% from over the last 14 months. And making a move also is SBI and Bharti Airtel, gains of 23% each. Now, the list of underperformers also is a list of some big names. Bajaj Auto, incidentally, also made a record high on the 27th of September 2024, is down 30% from those levels. Trent has almost halved during this period, and also making a move here are Coal India and TCS on the downside, losses of well over 25% each. Now, if you take a look at the movers from the April lows, some similar names here. BEL finds a mention here as well, at 53% from the lows in April. Mahindra & Mahindra, Eternal, Jio Financial and Eicher Motors here as well, gains of well over 40 to 50%. But you look at the sectoral indices over the last 14 months, banks have been the big contributor to this move. The Nifty Bank, already at record highs, is up 11% during this period. The auto index hasn't done much. IT, the other big sectoral weight, has somehow offset the moves from the banks. The pharma index hasn't done much, but the bigger underperformer compared to IT has been in the FMCG index. That's down 16% over the last 14 months. And the metals index too is up only just 2%. But if the Nifty is at record highs, the broader markets have done precious little during this period. The mid-cap index is up only 1%. The small-cap index, in fact, is down 7% over since September of 24. You take a look at the movers in the broader markets. You look at BSE. The stock has more than doubled, in fact, almost 2.5x from that period. Paytm is up 90%, still, of course, below its IPO price. Muthoot Finance hitting new highs. Indian Bank among the PSU banking names is up 64% during this period, as well as L&T Finance, not an NBFC that we talk about daily, but still up 63% during this period. Among the underperformers, of course, Colgate, IndusInd Bank now out of the Nifty, down over 40% each. Tata Tech, another Tata Group underperformer, down 40%. RVNL, the high flyers of 2023, down 40% as well. And Ireda, another PSU name among the list of underperformers. You look at the small cap names, Laurus Labs, after some quarters of struggle, is up almost 110% in the last 14 months. MCX at new peaks as well. Sagility, a recent listing. Naveen Fluorine, Narayana Health, all seeing gains between 60 to 70%. But look at the underperformers. Ola, that shows the pain in the broader markets over the last year or so. That Ola Electric, Tejas Networks, Jindal Saw, Brainbee is a recent listing, and 50 to 60% of losses. Whirlpool too. Now add more, another 11% too. There's 46% drop as well. So there has been pain in the broader markets. There have been stock-specific winners as well. But the point being today that the Nifty is at a record high.
You know, it's such a different feeling, Hormaz. Thanks so much. That's great data. And, you know, those stocks really illustrate the point why this all-time high is probably one of the most thanda all-time highs we've had in my recent memory, right? And that's exactly what it is. It's not been one momentum-driven market where everything is up and about and there's, you know, there's raging bravado. It's been almost an all-time high of disbelief. And even now the screen is a little thanda. But having said that, I think in the next couple of days we'll have the answer. And some of the technical experts were pointing this out. If the momentum now starts building up, if this level sustains, and if we cross the next 100, 200 points, and if something starts building, then maybe we'll be looking at a very different market. But yeah, I mean, as of now, it's been just quiet, thanda. It's almost like a relief. Chalo, finally, ho gaya.
The foreign guys need to come back and sustainably so, because everything else is there, right? But there's one missing element. Hopefully that changes.
Absolutely. And there's been a lot of sector churn. I mean, the winners are very different. There's been a lot of pain in the stocks that have fallen by the wayside in the last 1 year. So very different all-time high. Anyhow, one sector on which people have been increasingly optimistic, and you just heard Tahir Bajra also make that point, is real estate. So let's get that conversation going. Mr. Irfan Razak, CMD of the Prestige Group, is with us. Mr. Razak, thanks so much for joining in. You know, from a market perspective, and we were just discussing this with the guest who was on earlier. While all of you, most of the listed companies have been sounding optimistic, the numbers have been good, the pre-sales have been good, real estate stocks have been a little quiet and somber. But we're not discussing the stock with you, we're discussing the business performance. Super solid first half. The question is, can this sustain? Can this last? This 8-9% increase in pricing that you've reported, the kind of pre-sales momentum you've reported, is the going continue to be as good as you look at the rest of the year?
Good morning. I believe that the momentum definitely can sustain. It's all about how you strategize and how you work yourself up and bring in the pipeline. And since the going is good, since there is demand, the teams also have been working very, very well. And very hard to see that there is more and more inventory that we create and bring to the market so that the pre-sales can also be managed and the momentum is kept up. Yes, we have reached at certain highs. Now, from these highs, the only thing is that we have to sustain this. We have to make sure that the same momentum goes on. The demand will be there, but the most difficult part is bringing the inventory to the market. What it means by bringing the inventory to the market, land is the raw material, then it's the approvals and all of that. So it's a bit a tough job, but I think the teams have pulled this off in the last 2 quarters, and I think the next 2 quarters also should be pretty strong.
So, I mean, real estate obviously is a lumpy business, so you'll have some phenomenal quarters, and then 1 or 2 quarters there can be a lull. But if I average it out, I mean, you've been growing at 50%, at least in the last quarter. For this year as a whole, and more importantly next year, because, your launch pipeline has been huge, 18 million square feet, right? So give us some sense, on a sustainable CAGR basis, what's the kind of sales growth you're hoping to clock, not just this year, but going into next year as well? I mean, is 25-30% growth in sales momentum, is that a fair assumption?
I mean, it depends on what base you're starting at. See, now the base that has come up is quite huge. Nobody ever thought that a listed real estate or unlisted real estate company could do more than 10,000 crores in a particular year. Now that got surpassed. Then we talked about 15,000, that got surpassed. Then 20,000 got surpassed. So now we are all thinking that probably we can reach the 30K mark. But then at that level, at that base, for you to grow again 25% will be quite a challenge. But I think it would be fair to assume that we have to keep growth. And a fair growth between 10 to 12% on a very high base should be very reasonable to expect. And I think that's what we, along with the team, should work together to see that that is sustained. And because the market is there is demand, there is a need.
And that you're saying, sir, at the pre-sales level,
yes.
10 to 12% steady state pre-sales growth year after year in the near visible future, right?
Absolutely, absolutely.
Okay, and this is from here on, because pricing has also gone up in most markets, and we were having this conversation with Pavitra Shankar just yesterday. So pricing is also important to understand, right? And pricing has gone up very smartly. Even for you, I think realizations are up 8-9%. So from here on, this pre-sales growth, will it largely be a function of volume? Or is there some scope to enhance pricing as well, blended pricing across the portfolio?
No, I think it'll be more of volume. And I personally do not want the pricing to run up much more than what it has. Yes, pricing correcting itself and adjusting itself against inflation that's what is expected. But unreasonable pricing, because land price has gone up, expectations from landowners are more and more. That can't happen, and that should not happen. It's going to be counterproductive because we have to have an eye on the affordability also. We have to make sure the goods that we are producing are also acceptable at the consumer level, and the consumer is as yet able to still buy the product. It should not just go beyond their reach. So if we do a blend of both, yes, there is that niche market, which is the luxury market. That's a separate, I would say, a world altogether. But where the volumes will come from and where the business is the mid-income market. And that's where we need to have our eye on and keep working towards it.
Okay, all right. Hi, Mr. Razak. Just one quick question, sir. Good to hear that your business is doing well, and I'm seeing your projects coming up in Mumbai as well, which is good. The problem is this air quality is getting bad. And, various quarters of the government are saying that they're looking into it and they'll be sounding off various developers. Anything you have heard on that front and any measures that you're taking? Because the air quality out here is, really taking a bit of a hit. So your comment on that.
I think in whatever work that we do have to keep an eye on the environment, including the air quality. It's just not the developers who are responsible for the bad air quality. It's a combination of many things that happen. But I don't want to shrug that off. We as responsible developers would definitely like to take steps and measures that will not allow dust pollution to go out of our sites. There are many things that we can do, including, we have to have that proper shielding of all the dust that goes out of the property. Okay. We have to do, trucks have to be wheel washed when they go out. So all this will help. Even small measures do help. And at the end of the day, that is what is going to protect the environment and protect the air quality. And collectively, if it's done, it'll have an impact.
Sir, quick last question. That's air quality, and we're really dealing with it. I mean, just never imagined that a city that's next to the sea will have issues similar to the national capital, which is landlocked, but that's the unfortunate part we're in. Quick last word on the labour code, sir, and whether that impacts the real estate industry in any way. Do you see costs going up? Because now it's all getting formalized. You know, a lot of the additional benefits would perhaps be coming through.
I think labor is of late in the last few years has been a concern. Unfortunately, there's migrant labor that comes in from the eastern part of the country. It's who comes and settles down here and works really hard and produced again to churn the wheels of the economy. And they need to be protected. They need to be paid their wages correctly. And I do believe that labor has to be, one thing is skilling needs a lot more focus on. And we need to bring more and more quality of life for the labor so that they come and take these trades and they keep producing. Because
what is the cost increase, sir, if at all? I'm not sure, because there are 4 different codes and one of them deals with working conditions, health and safety, etc. So have your teams right now worked out if there is a cost implication, any increase?
There will be a cost implication, but I think it is for the good. And they will be, because see, I believe labor is the last person in the line, and their lives also need to be, they need to have a quality of life. And we should be the first to see that we protect that. And I think the cost increase on labor, just that component of labor, should be anywhere between 10 to 15%.
Okay, so labor costs could go up by 10 to 15%. That gives us a sort of ballpark working estimate. And of course, like you're saying, it's for the good. So it simply has to be sort of taken up. Thank you very much, Mr. Razak, for joining in. Good to get all of that perspective from you. You have a good day as we go forward. We'll take a break. And are we still retaining the all-time highs? No, we're not. We've actually slipped 26,243. After the break, we get you a special discussion on India's big push on rare earths. Rare earths, they're mining, taking it all the way to creating those magnets so we do not face a crisis like the one that the industry was in just a couple of months back. Back with that discussion in just a bit. Welcome back. Okay, that's a really important story that's breaking on your screens. It seems Tata Power's Mundra UMPP, the ultra mega power project, could resume operations by, well, December. And Vivek is picking up more details. Vivek, this has been stranded for so long, those power purchase agreements that just don't get signed, and the whole tariff issue. What's the latest?
Well, that's right. So it's an important development as far as Tata Power is concerned. What we are picking up from our sources is that Tata Power's, almost 4,800 megawatt ultra mega power plant, which currently is stranded. It doesn't have any long-term PPAs with any of the 5 state governments, and also it is not currently operating under Section 11, that is the Emergency Act, where power was being procured on a cost-plus basis. But what we are picking up is that now the plant is in a state of readiness, and as the management had alluded in its Q2 conference call, the company as well as the Gujarat state government have reached an in-principle agreement to go ahead and sign a supplementary PPA for this particular plant. Now, this actually will end almost over a decade of an overhang as far as Tata Power's Mundra facility is concerned. And this PPA, we understand, will be reflective of the current cost of the coal that is being imported. Now, also, the important thing is that in the conference call, as well as what we understand from our sources, is that all of the 4 other states, will actually use the Gujarat model as a precedent to go ahead and sign PPAs in case this does fructify. It's an important development. We reached out to the management and we've been constantly, getting their feedback as well. At this point of time, they are not responding. But an important, point to note is that in the Q2 conference call, in a pointed question that both we asked in the media call as well as the analyst call, the management said that while they could not run Mundra under Section 11, they are in discussions with the government of Gujarat to finalize and they expect that the conversations which are in the last stage should be done by the end of December itself, or they are hoping to close it by December. Just to note, in 2007, Mundra signed PPAs with 5 state governments, which is Gujarat, Maharashtra, Punjab, Haryana, as well as Rajasthan. Now, just to give some perspective as to how important this particular development is for Tata Power, when the plant was operating under Section 11, Q4 FY25, now the company reports this particular segment as a cluster of Mundra, coal, as well as shipping. So it includes also the Indonesian coal mines. It reported a profitability of 171 crore. And for FY25, on a base of almost 4,500 crore of PAT, this particular segment contributed over 1,000 crore. So it's an important part of the total financials. Now, in the 2 quarters where the company did not have the plant operation, Q2, the company actually reported a loss of 362 crore in this particular cluster. So any kind of relief, any development, or any positive action, especially from state governments, when it comes to Mundra, is an important development for Tata Power, and we'll be tracking this particular development closely.
All right, thanks a lot for that, Vivek. Well, let's move on then to the next important discussion. We have the Union Cabinet that approved an incentive scheme to promote domestic manufacturing of rare earth magnets with an outlay of around 7,280 crore rupees. To help us out with what this means for the industry and the way ahead, we're joined by Mr. Mohanty, the Director of Finance, IREL, and Mr. Panda, the MD at IMFA. Good morning, gentlemen, and thanks a lot for joining in. Well, Mr. Mohanty, let me come across to you first. I believe that y'all had plans to set up rare earth magnets plant in Visakhapatnam, if I remember correctly. What is the capacity, if you could tell us, and how do you look at the cost competitiveness post the scheme that has been announced by the centre?
Good morning to all. Actually, the point is rare earth permanent magnet are 2 types. One is from the samarium cobalt, and then another one is NdFe boron magnet. This samarium cobalt magnet IRL has already set off in Visakhapatnam. That is for the purpose of strategic use and not for the commercial use. The NdFe boron magnet, which is the scheme has come up with the initiative of the Government of India, which is a landmark step towards strengthening the domestic REPM manufacturing ecosystem. And this will definitely add technological self-reliance for the country. And this will bring the price disability currently around 43 to 44% is existing. This scheme will trying to mitigate that gap so that all the investors will come forward and this ecosystem for manufacturing of magnets will be developed in India, which is missing since long.
Mr. Mohanty, I just have a question on how the scheme is going to function. And I'm just quoting what the release said yesterday after that cabinet meeting. So the total scheme outlay is 7,280 crores. It has 2 parts. There is a sales-linked incentive, which is 6,450. And this is for 5 years. And then there's a capital subsidy for 750 crores. So can you help us understand how these sales-linked incentives will work? What are the thresholds? What is your understanding of the scheme? And it's open to all players, private and public. So will you be working with private players, or will you be largely doing this, setting up some new capacities on your own?
Particularly, this scheme is, the intention of the scheme is to invite private players to come and invest in this sector where there was a price disability. So for this, the government is looking for now particularly 5 different manufacturers to come where the maximum the subsidy will be given for 200 ton of magnet making, and minimum is around 600 ton something they have kept. So once the 200 ton magnet making will come per ton sales basis, this there will be one expression of interest, and based on that each bidder has to quote what will be the maximum benefit they want, the maximum subsidy they want from the Government of India. So on that basis, it will be worked out, which is envisaged to be 1,290 crore per annum for 5 years. It will be around 6,450 crores.
So will you be, again, the second part of the question, sir, is whether you will be partnering with private players or will you compete with private players in setting up these rare earth facilities?
It can be. Actually, the situation is wide open. The private players, if they have got the tie-up with different magnet technology providers, so private players can join with IRL, can do it, or IRL can take the technology from others and can set up, or IRL per se is responsible to supply this this NdPr oxide, which is the new rare earth elements, which is required for manufacturing of these magnets. So IRL will be,
yeah. So you can partner, you can do it alone as well. Just a couple of basic points. This subsidy, etc., is for actual magnets, not the mineral out of the ground. It's not about how much you mine, but it is about the magnets themselves.
Yes, exactly.
Okay, which means that there is a processing capacity, etc., which needs to be set up for you to do this.
Yes.
I remember in our conversation earlier, just to go back to the basics, you said that we have lighter elements in India.
Right.
The total reserve is about 7 million. Heavier we don't have, and that's the issue.
That is the issue.
How does that work against how does this resolve that?
Actually, I'll tell about that. India is the third largest resource for this rare earth ore. So currently we are having 8.35 million ton of rare earth. So for this, but this is lighter rare earth. So lighter rare earth, particularly NdPr we are having. But we require dysprosium and terbium, which are required for the this coercivity or to have this high remanence, which allows the retain high magnetization and the coercivity in the magnet. So if that is not there, then its manufacturing will be difficult. In Indian resource, it is not there. So it has to be imported. This is available. Out of China, it is also available, like Malaysia and Australia, it can be sourced. At the same time, India is also looking for this source from the carbonatite source, which is available in Gujarat as well as the Rajasthan Siwana ring, where ample quantity of this dysprosium and terbium is available. Around 5% of the rare earth oxide available there is available, but this is at the exploration stage. Quickly, it is in government of India is.
This is with GMDC.
Yes, GMDC is Ambadonga. And the other one is Bhatikara. Is again,
so you're saying some element which is required to enable the magnets to be made is available with GMDC and another entity in Gujarat.
The GMDC, this facility has not come up. Right now, this dysprosium and terbium has to be imported. And on top of that, there are technology available like Protorial and this VAC of Germany. They are having this technology of making rare earth magnets without using the dysprosium and terbium.
Right.
So, sir, what's the, and this is really important. So, while the intent is fantastic, we want self-reliance in these permanent magnets because of their widespread industrial use and auto use. But the success seems to depend on GMDC finding reserves of the, the certain, or you get a technology partner from, say, Germany, as you're saying. So, can you tell us from your perspective, Indian Rare Earths, are you looking to set up these facilities for the magnets? We're just trying to understand the competitive landscape. Will you then, are you assured of certain supplies from GMDC, or have you started a tech transfer conversation with the Germans, say?
It is not exactly German. German is there, one of them. Then Japanese, like Hitachi, which is Protorial now. The Protorial is there, and Sensex, which is the largest magnet manufacturers, they are also all available. So technology transfer and other things has to be examined. Once this this scheme has come now, then a lot of private players as well as foreign investors are showing interest. And IRL per se is the provider of this NdPr oxide. So the NdPr oxide will be provided by India, IRL. And this GMDC particularly, right now they don't have dysprosium and terbium. So this has to be definitely imported right now. And we are also looking for those technology which doesn't require dysprosium and terbium. And if it will be required, very, very minuscule only. Only around 0.5% of terbium and 1 to 3% of dysprosium.
All right. So just keeping those chemical compositions aside, just to understand simply, the scheme is for magnets, which is more downstream in nature, and the chain is rare earth mining to rare earth oxides to metals to magnets. Is that correct?
Yes, absolutely.
Got it. So let's bring in then a potential player. Mr. Panda has been waiting by patiently. Mr. Panda, you have excelled in your business, the only miner here of chrome ore in India and backward integrated with regard to ferrochrome. How big an opportunity it is for your company? And what is your comment with regard to this? The scheme has come out 7,000 crores. The center clearly is encouraging players to come in there. Exciting enough for you?
Well, it's certainly a very, very significant scheme, Nigel, because not only are rare earth magnets important in themselves, but look at the broader picture. This is, as you just mentioned, it covers the entire value chain from mining all the way through to magnets. Yes. Number one. But it is a scheme which has, implications and impact on major initiatives like Atmanirbhar Bharat, because you cannot, look at self-reliance in manufacturing or many of the sectors where, without having control over rare earth magnets. And equally, that has then an impact on your Viksit Bharat ambitions. And finally, if you look at net zero, because rare earth permanent magnets have have usage in defense, in EVs, in semiconductors, etc. So there are multiple sectors related to your net zero ambitions. So from that perspective, I think this is something very significant. And what you mentioned about INFA in particular, we of course have decades of experience in mining, in processing of ores, etc. Now, I do recognize this is a different cup of tea. Conceptually, it may be similar, but it is a different cup of tea. But inherently, I would say that we are amongst the few who understand it off the bat. And it's a question of going out and evaluating the details when the scheme is out in the public domain, as it is at the moment, going through the details and looking at what is there on offer. Mm-hmm. But off the cuff, I would certainly say that it is a great opportunity. It is something that we would certainly want to evaluate and see that how it fits in to our own sort of capabilities and strategic ambitions.
All right, and well explained, Mr. Panda. So there's an opportunity out there. We'll have to wait by for the fine print, and then in fact you'll take a call. But will you have to look for technology partners as well? If you could give us some kind of a sense in terms of partners that you'll be looking at, particularly on the technology front.
So I think two aspects are important. I was reading up on the scheme a little bit, what is available in the public domain at the moment. So it's both the sourcing of the rare earth oxides, and that's where IREL is an option. But I believe one has to look at some imports also, at least in the initial stages, while we focus on more sort of exploration, etc., to look at other resources. But this is where I think the government will come into play, both from a point of view of sourcing of the raw material as well as technology. And again, as Mr. Mohanty was explaining in his detailed intervention, that IREL itself could be a source of technology, but I believe there are other technology providers out there. So one has to look at it and look at it from I think this is something clearly one has to look at, not just from a commercial perspective, but also from a national interest perspective. Yeah. Which is the intent of this scheme is to bring about greater reliability to the supply chain. Yeah, so I think every decision that one takes, whether it is sourcing of the raw material or the technology supplier, etc., I think has to have a national interest element to it, which I can't say overrides commercial interest, but is as important, if not a little more.
Okay, no, absolutely, very well explained, Mr. Panda. Mr. Mohanty, so to you, for investors who are watching, I think you should list IREL. I think that'll be the...
Is there a plan?
Are you thinking about it?
Actually, IREL is a strategic unit. So far we are exempted from getting listed. So the options are open.
Okay. So
but has that gone up to Deepam at all, Mr. Mohanty? Any discussions?
Nothing has happened so far. It is all we are evaluating.
Okay, so it's not out of the question, but
yes,
of course,
yes, definitely.
Mr. I know this is an unfair question to ask you, Mr. Mohanty, but maybe let me put it to you since we have you and you've explained the entire value chain and so well. From a GMDC from a GMDC perspective, you said, well, they don't have production of this now. In your opinion, with this push from the center, how far out is production when we see meaningful output from the mines that they have, Mr. Mohanty?
I think 3 years down the line, 3 to 4 years down the line, that will take.
Okay, 3 to 4 years down the line.
Right.
Okay.
Because actually it is on the exploration stage, and now from the exploration to they have to the flow sheet and other things must have been developed by now. They have to invite the tenders, put of the plant, statutory clearances and other things are there. So that itself takes little bit of time. Other than that, setting up of the plant and getting the production 3 years down the line. And considering the scheme, whatever is there, and the kind of interest shown by private as well as the government sector, so it seems 3 years, 4 years down the line, 2030, the India will be definitely self-reliant.
Got it, Mr. Monty. Thank you very much, Mr. Panda. Appreciate you joining us as well. Very useful and insightful discussion, and we wish you both the best of luck as the scheme tries to help in this, building out this ecosystem. Sensex has hit a new all-time high as well. So we've crossed 86,000 for the first time. Nifty, of course, 26,300. So records all along this morning on both the Nifty and the Sensex coming through. I mean, the small cap index, of course, now some distance away. The Nifty next, of course, is also close by. What we'll do is we'll take a quick commercial break here. We're going to come back. We'll just look at commodities and what's top of mind with Manisha. Stay tuned. Coming up.
Welcome back. Fantastic morning for equities, all-time highs. Let's see what's happening in commodities. Manisha, over to you.
Thank you for that. I'm making it a sweeter Thursday for you because I'm talking about sugar right now, where we have seen the prices gain up in the international markets. We've crossed above 15 cents a pound, and that is a one-month low, one-month highs coming in for the sugar prices. So when you look at the overall move that we've made in case of sugar, it has gained up by nearly 5% for the month of November. YTD, we still seem to be holding on to those gains of around 21%, as you can see on your screens. And this is going to be a second straight year of negative moves coming in for the sugar prices. Well, the reason for this is that almost all countries seem to be producing more sugar. So last year, we were dealing with a deficit of 2.9 million tons. But this year, the new season, that is, we have a surplus of around 1.6 million tons. This is what is coming in from the International Sugar Organization there. Having said that, we are looking at higher production, not just from India, but from Brazil, which is the largest producer of sugar, and then Thailand, which is the third largest producer of sugar. So between these three countries, we are looking at higher sugar production this time around. Having said that, India will also export 1.5 million tons in the global market in the new season. That would mean more sugar entering the international markets there. Interestingly, when you look at the new season there, almost all agencies which have come out with their numbers yet, whether it's about ISMA, NFCSF or CRISIL, are all talking about 35 million tons of sugar this time around, which is nearly 18% higher from what we had in the previous year. Reasons for higher sugar this time around is one, higher cane acreage. The second is about favorable weather. And we also are looking at higher yields this time around. The India sugar industry has a lot of concerns, though. So even as we are looking at higher sugar production this time around, the MSP revision for sugar has not happened since 2019. At that point in time, the sugar prices were set at around 31 rupees a kg. That is where it stands right now. While the cost of production has increased to 41 rupees a kg, that is because you have seen constant hikes in sense of FRP from 275 to 355, but it also has been about the state advised price, which is SAP, which has been increased. Add to that the bonuses as well. So the price that the mills are paying to the cane farmers is much on the higher side, but the sugar realizations not so much. The other thing really is about the ethanol prices, which also have to be revised. For a third straight year, we haven't seen a revision in that. And this season is started, markets are anticipating could happen in the next fortnight or so. The other thing is about the concerns that the sugarcane distilleries are working at less than 50% capacity. So when ethanol blending was started and the whole plan was put out, it was to ensure that the sugar goes into this. But if you look at the rotation, or rather the ratio right now, that stands at 30 to 70. So 30% is what we are seeing coming in from sugar, and 70% of ethanol right now is coming in from grain base. A bit of a heartburn when it comes to sugar industry there. If you look at the global prices, they have declined by 22% in this year. That doesn't augur well as well for the exporters right there. And then it also has been about volatile production trends, compensation from the, competition from the good and unorganized khansari sectors as well, are some of the challenges that sugar as an industry seems to be facing on.
All right. Thanks very much for that. Manisha, appreciate you taking us through top of mind in terms of the commodities and soft commodities in focus. Lata is going to be speaking with a very special guest on the other side of this commercial break. Axis Bank MD and CEO Amitabh Chaudhary on their FY27 outlook. That's coming up in just a bit.
Welcome back. Axis Bank shares are trading at all-time highs, of course. Sensex, Nifty and the Nifty Bank are also trading at all-time highs. Axis Bank posted perhaps the fastest loan growth compared to the top three private banks at 11.7% in the second quarter. There was a very good margin management as well. While many brokerages, Jefferies, Nomura, HSBC, have all a buy rating on the stock due to the better valuation, analysts are worried about the repeated one-offs that have hit the P&L and, of course, more lately, some high-level resignations. To get an idea about the bank and how it sees the coming year, that is 2026, I have with me Amitabh Chaudhary, Managing Director and CEO of Axis Bank. Amitabh, good morning. Thank you very much indeed for your time. You're the first big banker we are speaking after the festive season. So how was it? How was the loan demand? And would you want to substantially increase your loan growth guidance?
So, Lata, thanks a lot for calling me on your show. Let me start answering your question. Loan growth during the festive period reflected strong customer sentiment and structural enablers. So just to give you a sense, on the Wheels business, we achieved a strong growth in October 25 versus 24 of 21%. And obviously, this was driven partly by the pent-up demand of September flowing into October and some of the GST rate cuts, which you saw, obviously the buoyant festive sentiment and positive customer confidence stemming from all the actions which the government is taking, and so is the regulator. And we saw some similar trends on the mortgage side. Even on the card spends, we got an extra boost with GST benefits coming in right at the start of the season. So we saw strong demand and double-digit growth across key categories such as durables, shopping, and online marketplace sales. For example, in card side, we had partnered with almost 200 brands during the festive season. So overall, the sentiment was positive. November, the trend is looking decently good. I wouldn't say, obviously, it will not be a repeat of the festive season, but overall, the market sentiment seems to be strong. You're also seeing clear upgrades coming through on the expected GDP growth rates. So I think that is also getting reflected in real projections on how the economy is expected to do. Obviously, I mean, there are always challenges, but overall, the sentiment does remain strong.
So you would want to give us a guidance?
Okay, sorry about that. Well, we are progressing well to be a stronger and sustainable franchise. We've been talking about that theme for quite some time. We do believe our platform will allow us to grow at rates faster this year than the industry. And this thesis, we believe, will continue to play in the medium term. The supportive regulatory conditions and the operative landscape obviously adds to our confidence. We have also said that in the medium term, which is defined as 3 to 5 years, we believe our advances growth will be above the industry growth rate. So, yes, obviously, the credit growth rate is picking up. The numbers seem to indicate that. The deposit growth rate seems to be a bit tepid. But our view is that given the pipeline we have, given the momentum which we are seeing, this year we should be able to maintain a growth rate higher than the industry. And then obviously, in the medium term, we also expect to continue to drive our platform accordingly.
Okay, time permitting, I will come back to this. The more recent news that hit the exchanges was the resignation of the chief risk officer. Now, actually, I went back. For the past year, you've had not just Amit Talgeri, which is the most recent risk officer, Arjun Chaudhary, the affluent banking and cards guy, resigned, S. Bhaskar, the chief of audit, Ganesh Shankaran, wholesale banking, that was 1 year ago in November. So, I mean, is there a pattern we have to read, or were these all personal decisions?
Oh, well, there is no pattern here in the sense that, firstly, recognize Axis Bank as a great platform where we are generating talent which people want to hire. In some cases, the decisions have been personal. People have been doing the same job for a long period of time and they want to take a break. And so in some cases, some of the names that you took, people actually have picked up jobs post leaving us, which are more slightly less intensive in nature than what they were doing earlier. So it's not leaving the organization, it's making a lifestyle choice. In some cases, they've got opportunities which are very, very different from what they were doing in Axis. I mean, you took one name where the person is gone and is running a very small company, but the potential to grow it larger is huge. This is kind of a completely different platform. So I think the reasons are individual. I don't think it reflects anything on Axis, but I'm quite glad that people are now seeing Axis as a place where they can hire extremely good talent.
Oh, yes,
And
yes.
we have replaced Amit with someone internally. So we have enough talent internally also where people are getting opportunities to grow.
Okay. No, if that's the reason, that's very good. I just noticed the pattern. Let me come to the other news which CNBC-TV18 broke. My colleague Yash Jain broke a story on the Insurance Amendment Act that's going to be tabled on Parliament. And there is a major liberalization in the sense insurance companies may be allowed to merge with non-insurance companies. Now, you have, of course, Axis Max and Max Financial. Do you think, therefore, a merger is imminent? If this is allowed.
It's been on the cards for a long period of time, Lata. I mean, we have been hoping that the new insurance bill will allow merger of these entities. The core business will obviously remain insurance, and that's the only business they will do. Here we have a unique case where there is a holding company which holds shares in an insurance company, and so that's the only thing they hold. And we would like to have a merger so that the shareholders of that holding company can take ownership of the Axis Max Life Insurance directly. Recently, you would have also been aware, when the story was broken, that IRDA has decided not to pursue the case in Supreme Court. So it's an indication from IRDA that maybe the bill is coming or they will allow something like this to happen. Our views are that there is further guidance expected from IRDA on this matter. And based on that guidance, we will act. Our intention and hope is that we will be allowed to merge the two entities so that there's only one entity which is out there. By the way, Axis Max Life is doing exceedingly well. And I think that is also reflected in the stock price and their market share gain. So we're very delighted with the investment we have made and how that entity is progressing.
Okay. You all had also expressed a desire to increase your stake in Max Life, that is Axis Bank's stake. But there was the SEBI investigation on the pricing. Anything latest from SEBI? And therefore, if that is a done deal, can you go ahead and raise your stake?
Well, the investigation from SEBI side is going on. Normally, these investigations and this process takes time. So we are going through the process. We believe that we have a very strong case here. That I think whatever we have done is with the full approval of the regulators involved. But obviously, SEBI as a regulator has the right to go deep into the case and take their view on whether what we did was correct or not, and we are going through that process. We would obviously like us to take our stake to 20%. We would also like to, understand once the forms of business circular comes as to what some of our options are. Right now, we don't know. And at the right stage, we will see whether we want to increase our stake or not. We cannot take that decision unilaterally. There are other shareholders involved, so it will take time. Right now, there is nothing on the cards.
Fair enough. Anyway, regulators seem to be in a more liberalizing mode. So let's see. Let me now come back to your P&L. Margins, it was a pleasant posting that you all did, just 7 basis lower NIMs. What is your sense about, will Q3 be the bottom? I think that's what you guided, that Q3 will be the worst. And there is a possibility of another rate cut. So then what happens to the NIMs?
So let me start by saying, assuming there is no further rate cut, let me give that position first. We expect margins to bottom out in Q3, mainly due to a slight, and the reason why margins might go down in Q3 is because of a slight tilt of loan mix towards wholesale over the last few quarters. And obviously, we'll see the agri seasonality impact in Q3. A bank has maintained that through life cycle, the cycle stance of average NIMs at 3.8%. And cycle is measured in terms of duration of 15 to 18 months, starting from the date of last rate cut in June 2025. So we are maintaining that stance. We do believe that the margin trajectory is like an inverted C. Effectively, margins will moderate when the rate cuts are announced, drop on the inverted C, and then it starts climbing back towards the end of the duration period, because then the kind of deposit rates also catch up. We all know that the expectations in the market on the rate cut are quite high. I think people are almost assuming that the rate cut is pretty much a given because inflation projections are low. And that obviously the impact of GST cuts is flowing through. So my view is that a rate cut might happen. So some of the commentary which we have given in the second quarter might change. But the overall, if you kind of expand the time period, overall our commentary on margins does not change. Quarter to quarter, it might be different because there is a additional rate cut that might come in.
Okay, fair enough. Now let me come to credit cost. Both credit cost and slippages as ratios fell, and that was positive. But you all have not gone back to your Q4 lows. Last year Q4, your credit cost was 50 bips. Now you are 73. What should be the direction of slippages and credit cost? Can it go further lower?
We do not provide any guidance on the credit cost, but financial 27, we do believe would be normalized with effect in comparison to financial year 26. Okay. So we have had some one-off events. Firstly, they will get normalized. Secondly, credit cost cycle itself is witnessing a normalization from through cycle trough seen in financial year 23 and 24. So despite this normalization process, so for 23, 24 were way lower than where they should be. Then we saw obviously a spike. Now we are kind of coming down to normalized levels, which will be slightly higher than financial year 23-24. Okay. But our view is that they will settle at levels lower than what we are seeing right now. And obviously, Axis Bank has been quite conservative in terms of the approach it has taken to the kind of the risks which you want to take in the business, both on the wholesale and the retail side. And our view is that this will continue. So overall, things are stabilizing, and they should stabilize at levels lower than where they're seeing.
Okay, I have just one more question on that, but let me get out of the way. A worry which analysts have, while you are a buy, the stock is a buy for many of the brokerages. There's just this worry, twice in a row you had a one-off. Yep. So, and then on October 9, there was another caution from RBI. So should we expect another one-off, or is it over and done?
See, some of the one-offs which were there were subject and based on continuous evaluation of our policies, products, services. In some cases, we discovered them ourselves. In some cases, we were guided by RBI. Right now, we are not aware of anything which would result in a one-off. But, I cannot guarantee that this will not happen. Yes, we have taken that one-off. And the last one-off which we took, we have very clearly stated to the market that we expect this amount to be written off or written back completely in the March 28 quarter. It just, gives us, increased provisions in what we had earlier. We always had the COVID provisions which we have not touched. So we do believe we are a conservative institution, as and when we discover something where our standards or our accounting policies are slightly, below what a typical conservative institution would have, we will step up very, very quickly and take whatever hits we have to take. We are not aware of anything right now, but the interpretations do change. Sometimes you do see things where maybe you could have done it in a slightly different way. That keeps happening, but hopefully the size of the balance sheet we have should be able to absorb them without too much of a problem.
Fair point. No, of course, it didn't impact margins, etc. Just now coming back to that slippages part, most of the banks, including yours, were lending a lot of loans to MSMEs. Now, do you see any danger at all? I mean, for other banks, they went even 29, 28% higher on MSME loans. In your case, I think it was 16% higher year on year. You don't see any danger over there, is there, MSMEs?
Well, as you rightly pointed out, there is an increasing commentary coming from NBFCs that MSME side of the business is seeing trends which are negative. And right now, let me just clarify once again, we have not seen any signs in our portfolios, although we continue to keep a close watch. The fact that it is happening somewhere in the industry and we are in the risk-taking business, we should obviously, be reading this commentary very, very seriously. Okay. Just to clarify why we might be different, significant portion of our MSME book is secured by way of immovable property or assets. So it adds comfort not only to the underwriting toolkit, but also recovery in case of stress. Just to give another data point, 85% of our portfolio and 87% of our incremental sourcing is from SMA 3 and above borrowers, which is obviously higher rated borrowers. So these rating scales are back tested and monitored with rigor periodically. And as on today, they demonstrate performance above acceptable levels on various parameters. Another data point, 70% of our loans are short tenured. Hence, reducing exposure to default is easier, or you can monitor them faster and lower than the long tenure loans. We also quite well diversified geographically and industry-wise. So there are things which tell us that, okay, we might be slightly better placed, but I do not want to kind of walk away from the fact that the industry is feeling some stress and we should be watching our portfolio like a hawk. And that's exactly what we are doing. By the way, the recent announcement from the government on the relief package, which is similar to the earlier ECLGS scheme, will also give some breathing room to some of the SMEs who might be suffering. So watchful, right now seeing no signs, but being extremely watchful about this portfolio.
Oh, thank you very much, Amitabh, for a many-sided interview. I could have gone on, but out of time, and the stock continues to rate at all-time highs. Thanks a lot.
Thank you. Thank you so much, Lata. Thank you.
Okay. Well, there you are. All indexes at all-time highs. Sensex, Nifty and Nifty Bank, and the stock we just spoke about, Axis. On that positive note, wrap up on Bazaar Chartbusters coming up.